Joseph Hogue here. Thank you for joining us for another live stream. Just getting started, getting back to these after months long of not doing any live streams. Love getting back to have that connection with you guys at the Q&A, the topics that we're discussing. So we're going to try doing these at least once every 2 weeks. So we're going to try doing a live stream on Tuesdays. If you have a topic you want us to discuss or anything, just go ahead and put that in the chats. I want to get started though here because real estate has just been a dumpster fire over the last year. 2 years. REITs are down 25% in the last year. You see this in the NAREIT, National Association of REITs, investment property by property sector, or performance by property sector. We're going to be revisiting, going back to this report quite a bit in this live stream to show you, how REITs are doing, how they're doing this year, and talk about how they might do next year, which property types I like, because you really do have to look at REIT investing, real estate investment trusts, and stocks there by property type. Obviously, there are vast differences between the property types, which ones will rebound faster, which ones had the highest upside. It probably wouldn't surprise anybody to know that probably the hardest hit property type in REITs, in the REIT universe over the last 2 years, could have the highest upside here over the next couple of years, and I'm going to discuss why that is and why I think that could be, and some of the properties or some of the REITs to look at for there. But you do see here up at the top here, there's NAREIT All Equity REITs Index down 25%, 24.95% back in 2022. Obviously, a lot of that is rate driven, and I'm going to talk about how that is, and only 3% so far year to date. Okay, that's against 16, 17, 18% rebound in the S&P 500. Of course, the NASDAQ index of tech stocks there is up more than 20% so far this year. So REITs underperforming this year as well. And we continue to see all kinds of bad news about real estate investment trusts. This one is on Ashford Hospitality Trust. It's a REIT of hotels and leisure properties there, expected to hand the keys back to 19 hotels back to the lenders. We're seeing that across a lot of property types here with those higher interest rates. And what you have to understand here, folks, with commercial property, unlike your home property, unlike your home mortgage, where you're paying the equity and the interest each month, so you're building up a little bit of equity in that house each month. Most commercial property is structured. The mortgage or the loan is structured to interest only, right? So over 5, 10, even longer years in that commercial property loan, these REITs and these property owners are only paying the interest each year. So they refinance that loan, or they expect to refinance that loan every 5 to 10 years. And obviously with the idea that property appreciates as it gets, as the years go on, and is a good inflation hedge, then that's usually not a problem. The price of the value of the property has increased, so there's no problem then refinancing that property, even sometimes for a higher value. But obviously that's run into problems here with a lot of these properties financed, over the last 5 years at near zero interest rates, and now having to be refinanced, having to go back to the lenders and get those loans that with interest rates up as high as 7 and 10%. And a lot of lenders are just finding that, with the interest expense now due on, every year on those new loans, the cash flows don't cover it. So they're just letting those hotels, the office properties, go back to the lenders. It's not a problem for the REIT total or the real estate owner on total, because usually what they do, they structure each property, so each hotel, each office building, each complex as its own LLC, its own limited liability company. So they can default on one loan, and it doesn't come back to hit the whole REIT as a business. But we're seeing obviously San Francisco's having big problems there with office, with hotel, as well as retail there. A lot of some big malls there. We're seeing nationwide office property vacancy rate up to 17%. I actually just saw news this last week that distressed office property, so office property either in default or near default, is actually more higher than retail property now. Over the past 10, 20 years, retail properties, malls and retail stores have been the most distressed property type because of that rise of e-commerce. Now it is office space. So office space, clearly the big loser so far in that, in the property, in the real estate sell-off. But this could actually be the best time to invest. I want to show you another chart here. These are the annual these are the annual annual sector performance in the S&P from 2008 all the way to year to date. And if you look here, okay, we had 42% sell-off in REITs in 2008. Obviously, that was the great financial crisis. The real estate crash there in 2008, down 42%. But if you look at how real estate did in the years following that, I've seen other sector performance reports where real estate was the best performing asset in 5 of the next 6 years after that. In here, it's down a little bit. It's you seen that next year is 27%. The year after that is 32%, 11%, 19%. But the trend is obvious. After you get these huge sell-offs in real estate, this blood in the street mentality and crises in real estate, it becomes a lot of times one of the best investments you can make. So I want to talk about, kind of the outlook for real estate, why it could get worse before it gets better, but why you might still want to start investing now, start kind of edging into your exposure in real estate. Again, I'm not suggesting that the pain is over for REIT investing or real estate stocks. Obviously, we have to see some massive write-downs of valuation on these office properties, especially. I'm going to talk about why that is, why it is so hard to convert our office property into other property types. That's kind of a myth that all these buildings can just be converted into apartment space and that kind of thing. That's not going to happen. We're going to have a massive write-down in office property types, as well as just a lot more urban parks coming up over the next couple of years as these older office buildings are just torn down, right? Because it's just they can't sell them. The size of the write down in valuations in a lot of these office buildings is going to be so much that it's just going to be better use to tear it down, use it as a park, or build up some other kind of office property. But I want to talk about why the real estate market has been hit so bad. It's mostly rates, but it's some other factors as well. Work from home is obviously affecting not only office, but also that urban retail, as well as the hotel business travel. With more people working from home, there isn't nearly as much business travel demand for those hotels. Obviously, all these stores, the retail stores in urban areas, aren't getting the kind of traffic that they used to. So that's contributing to not just the office weakness, but a lot of the weakness in a lot of these other property types. It's but you can see here again in this investment performance by property sector that the returns last year and this year are very different by property type. So you really do have to look at this by property type. Obviously, we see this huge sell-off, 37% last year in office properties, down 16% this year. That pain continues in office properties, but some of these. If you look at data centers down 28% last year, already up 19% this year, though. So that rebound has already started in data centers. And you look at some of these other property types, 9% up in self-storage already this year. So very much a tale of two cities, tale of two stories here in different property types. And it is mostly those rates again. Obviously, real estate is very highly leveraged, and that contributes to more than one factor into real estate. Okay, obviously, if real estates are higher, it just makes getting that loan and the valuation on that property so much more difficult. So obviously property values come down, just higher interest rates means higher interest expense. Again, like I said, most commercial real estate loans are financed by just paying off that interest on a month-to-month basis until it needs to be refinanced. So higher interest rates means, higher outflow of cash to pay those interest rates or to pay those interest expenses. And a lot of the properties that were cash flow positive with those low near zero interest rates over the last couple of years are now cash flow negative. So that's why we're seeing a lot of them just go back to the lenders. And that's how that rise in interest rates has hit not just the valuations, but also the operational aspect of these REITs and the valuation, the operational cash flows of these properties. But I do want to look at returns and a couple of reasons why you still want to own REITs, okay, and why you really want to take advantage of what could be a 2024, 2025, or even a multi-year rebound in these. So I want to look at this. This is the the REIT Watch, NAREIT REIT Watch, and I'll show you how to find this real quick before we get in there, because we're going to be using that quite a bit as well. If you want to find these two documents, the performance by property sector, as well as the REIT Watch document that we'll look at, and I'll share my screen here so you can see it. What you want to do, you want to either go to NAREIT. So NAREIT, that's the National Association of Real Estate Investment Trusts. You go to there, and you're going to find two places that you want to look to find data here. First, you're going to go to REIT data. See if this loads up. It looks like my internet's kind of slow here. See if we can just go straight there. Okay, you can while that's loading up, you can go NAREIT Property Sector Returns, and you're going to find this performance by property. You click on that, and that's going to take you to this document, the investment performance by property subsector. We're going to be using that a lot. And then if you go to NAREIT itself, and you could look in the, that doesn't look like it's loading up. If you look in the upper menu, you're going to see REIT data, which you can click through here too as well. REIT data, and then you go look for the REIT Watch download. It's a monthly download of real estate information, some great information here. We're going to be sharing a lot of this with you here in this live stream. But I want to go down here to show you this. NAREIT All Equity REITs. Now this is all equity REITs, so this is all REITs traded in the stock market. And you can see here annual returns since 1972 all the way through last year. And obviously we see this huge sell-off last year, 25% down for equity REITs. But the average annual total returns is still 12.76% over this entire period. That's even including these massive sell-offs here, 2008, 2020, quite a few big crashes here over the last 50 years in REITs, still 12.7% return. The annual income returns, okay, so just the income returns on those dividends paid out by REITs, 7.3% on average. That 12.8% annual return is better than S&P returns. Here we have the S&P returns over that same period up just 12% over that year. And you see the big sell-off last year in stocks in the S&P 500 as well. So REITs, even with last year's big sell-off, outperforming S&P, so the overall stock market returns. I also want to show you, we already looked at the performance by, where is that? There it is. The performance of REITs over the years, many years, the top performing sector. We had 2010, 2014, real estate investment trusts were the top performing sector. Many years after these big crashes, you see really strong returns from there. I also want to show you this back on this REIT Watch data. If we go here to the correlations, which is actually 17, page 17 here, we can see correlations. Now what this is correlations, comparative total return investment correlations between different investments, right? So you have REITs, so real estate stocks, you have the total stock market index, the Dow Jones, you have the NASDAQ composite, NASDAQ 1000, S&P 500. So you got all the different stock indexes and different investments. You got commodities down here as well. And now what correlations are, it's how closely the returns in one investment tend to follow another. Okay, so a correlation of 1.0, which would be perfect correlation, which would mean that two investments, the returns follow each other exactly. Okay, when one goes up, the other one goes up. When one goes down, the other one goes down, and generally by the same amount, right? That's perfect correlation. Perfectly negative correlation would be -1. And that would be just the opposite. Okay, when one goes up 5%, then the other one tends to go down 5%. That would give you pretty much a flat line in your investments if you had perfect negative correlation. What you want to try to be doing with your portfolio, folks, because this is very important. I know it's getting a little technical, a little math-based, but what you want to try doing with your investments when you're buying bonds, when you're buying stocks, when you're buying real estate, is because they don't have those perfect correlations. They do not tend to rise and fall the same when other investments do. So if we look at the all equity REITs, the correlation here across the top with these different types of investments, we'll look at just the S&P 500 here, 0.69, correlation with stocks of 0.69. You see that same correlation pretty much across these stock composite indexes. So the NASDAQ 0.63, NASDAQ 100 0.61, S&P 500 there 0.72. So that means that, when stocks rise, real estate stocks are going to rise as well. They tend to rise as well along with stocks because they are traded on the exchanges, and they do, kind of benefit from that investor sentiment. When stocks fall, REITs tend to fall as well, but not perfectly a one-to-one relationship, right? So what's going to happen is sometimes your REITs are going to be doing really well even when your stocks aren't. Sometimes your stocks are going to do really well even when your REITs aren't. It's going to tend to balance out those ups and downs and the roller coaster that we all see in the stock market from time to time. And it's just going to give you a little bit more stability, a little bit less stress in your investments. So again, just another reason to own real estate, even though sometimes the returns might not be perfect or might not be those meme stock returns that we get from some stocks, right? You still want to own real estate because the long-term average annualized return is actually higher than stocks, and because it gives you some of that diversification benefits, with a stock and bond portfolio. Now we want to talk about, what's going to turn this train wreck around, right? What's going to extinguish that dumpster fire, and why I think that REITs could be some of the best property or some of the best performances here over the next couple of years. Okay. One, we're going to have to see huge asset write-downs in office space. Okay. Nationwide, even vacancy rates continue to rise. We are not heading back to the office anytime soon, even though it is tending to kind of stabilize a little bit. But again, these office properties, they can't just be converted into another property type like residential. Okay, if you look at most office buildings, most office spaces, they don't have windows that open. They are large open spaces that don't have the same plumbing that you need for residential. So it just becomes so expensive to convert a office space into residential or into a lot of other space that it's just uneconomical to do that. I know it bursts the bubble of a lot of office space investors that think they can easily convert stuff like that, but it just isn't going to happen. So we are going to have to see massive write-downs still of office property. That is probably another 6 or 12 months in the making. Obviously with office property tenants, those tenants are signed on to leases, multi-year leases, 3 to 5 years often, and so those get worked out as over 3 to 5 years. So commercial real estate tends to be kind of a slow-moving train wreck rather than stocks, where you'll get 1 year of a steep sell-off like we saw last year. Stocks down 35% through that October low. Stocks just crash and then they rebound quickly. Property, it's a little bit longer to rebound, usually 1.5 years, 2 years, to really find the bottom in those, especially the hardest hit property types like office space, like what we're seeing now. The big thing that's going to turn this around, and why I think 2024 is going to be a very good year for real estate, is just because of those the interest rates, right? We know that interest rates were the big factor in driving down valuations across property types. Okay, not just office, not just because of that pandemic work from home trend that we just started over the last couple of years, but because the Fed raised interest rates for the fastest pace in 40 years. Okay, the Fed had not raised interest rates that quickly as they did last year since all the way back to the inflation scare of the 70s. Okay, they raised interest rates from 0 pretty much to over 5% last year. We're still seeing some of the effects of that on the economy, but we started to see it immediately in office space or in property types in real estate. Not only on the valuations, but also just the cash flow aspects of those properties. Now, what's going to change? Obviously, inflation is coming down. It looks like it could be, very close to the Fed's 2% target by the end of the year. And of course, now, again, this is the PCE inflation report that we'll see actually later this week. On Friday of this week, we'll get a new PCE report of inflation. That's not the CPI. The CPI is a little bit higher. Consumer inflation is a little bit higher than those personal consumption expenditures that we're seeing. The PCE report right around 4% right now, expected to be maybe 3.9% this Friday when it's reported, very close to that Fed target of 2%. That is coming down even faster, and that's going to put the Fed on a wait and see approach, right? We are expecting the Fed to raise interest rates one more time this week on Wednesday when it meets, up to a Fed funds rate of 5.5%. But that is expected, and I'm going to show you the expectations for that. That is expected to be the last interest rate increase by the Fed. Again, inflation coming down fast enough that they don't have to be so aggressive against inflation anymore. The economy is slowing down, so it's giving them pretty much a Goldilocks scenario of what they need. So what we're looking at here is the Fed Watch tool. We use this on the channel quite a bit. You see this, you find this on the CME Group website, CME Fed Watch tool. It's a great kind of market-based approach at looking at what the market is expecting as far as Fed rate hikes. Okay. So this is based on futures pricing for interest rates for the Fed funds rate there. And it shows you really what the market is expecting the Fed to do in each of its meetings, all the way up through December of next year. And we see here that in the blue is the market odds, right? What the market is expecting. We do see here 726. So this Wednesday, we are expecting the Fed to increase rates from its current 500 to 525 basis points up to 525 to 550. So that would be a quarter of a 25 basis point hike up to a Fed funds rate maximum target of 5.5%, 550 basis points. So we are expecting 98.9% confidence, 98.9% market expectations of that. But if you look here for the expectations for the coming meetings, all the way through March of next year, we're expecting the Fed to have held steady and not raised interest rates anymore. 36.4% market odds that it will still be there as of March of next year, 35% that they will actually have cut rates. So almost 50-50 odds that whether they're going to hold in that March meeting or cut then that first time in that March meeting. But then look at what happens at the market odds. The market is confident that inflation is coming down so fast and that the economy is slowing down so fast that it is going to give the Fed room to just start cutting rates aggressively next year. And I actually saw their Double Line CEO, new CEO for Double Line just over the last year here, I think, is predicting that the Fed is going to be a little bit behind the curve on cutting interest rates, but is then, because of a very fast slowdown or even a recession in the economy next year, is going to be forced to cut massively in just like one meeting, like cut 1% in one meeting. Obviously that's not the consensus here. The consensus here is that they're going to more slowly cut rates. We have the first cut here either in March or May here. March or April here, excuse me. But then, maybe they hold pat here at 475. So 475 to 500, and then cutting aggressively, one cut every meeting, all the way up until the market odds right now are that the Fed has cut down to 400 to 425 basis points by the end of next year. Okay, so that would be 1.25 from a top end of 5.5% all the way down to a top end of 4.25%. That would be 1.25 points or 1.25% cuts to interest rate by December of next year. So again, obviously, you got to think about what this means for real estate that has been hit so hard for, by those interest rate increases over the last year. Okay, 1.25% interest rate cut there. It's going to mean these properties cash flow better. It's going to mean, it is much easier to get a refinance on the properties because the property valuations are going to go up as those interest rates go down. For all you out there like ourselves, we're actually closing on a house over the next week, the 31st. We're closing on a house and the interest rate has just gone crazy over the last couple of months. We're hoping to be able to refinance that here in the next year or two. And it looks like if these expectations are correct, then we'll be able to do that within, year and a half, 2 years. We'll be able to lock in a much lower rate on that. So you're going to see interest rates come down pretty quickly here next year. Now, of course, the stock market is always forward looking. They're not going to wait until these interest rates start coming down or even appear to start coming down before really bidding up those stocks that have been hit hardest by this. So I think even before that March interest rate cut that is kind of 50-50 odds of being the first cut there next year, I think you're going to see these real estate stocks really start to come forward. We're already seeing, some hedge funds We're already seeing some people come into the market trying to get, bottom basement prices. Hedge funds are already, it says here, Wall Street Journal, brawling over battered commercial real estate. Okay, distressed investors or investors in distressed debt and distressed property already coming into some of these property types and taking advantage of the outlook for negative or for lower interest rates. Okay. Now, I'm not saying that not going to be putting all my money into REITs just yet. Like I said, especially in some of those property types like office space, I think you still do see some pain to come just because those leases are staggered and it takes a little bit longer for them to respond to those higher interest rates. So I think, and we're going to go over each property type, how it's reacted, how I think it's going to react over the next year, and look into some of the companies specifically in those property types. I think some of those property types you can start building a position now and start building that up. Some of the other property types, maybe you wait for 3 or 6 months and then start building up into that property type. But I do think you need to start building a position pretty soon in a lot of these, because again, that market reaction to eventual lower interest rates is going to start being priced into these stocks, into these real estate stocks, much sooner than it actually happens with interest rates, much sooner than the actual interest rate cuts start coming through. So you're going to want to be ready for that. I want to show you how to find these. How to find these property stocks, kind of talk through this report that we looked through and the property types step by step. First, I want to cover it by property types. All you out there in the nation know I love this kind of top-down idea for investing. It is so much easier to start with the top-down. Look at, okay, by property types, which property types do I like the best? Which property types do I think is going to take a little bit longer to rebound and to recover? Then starting there, then we can look at each individual REIT within that property type and have a little bit better confidence that we're going to be, we're going to see better returns, right? So if you pick, for example, if you pick the property type that is the fastest to rebound, then it doesn't matter what REIT within that property type you pick. You're probably going to make a pretty good return because that the bigger picture is going to lift all boats within that. So we want to start at that level. So here again, we are on the investment performance by property sector of the NAREIT. So again, you just go to NAREIT, and this is finally loaded up. If you go to NAREIT and you go to performance, I think it's usually REIT data here that you click through, and it's going to show you the REIT property type. Here's the property sector performance. You can look at that one, or this REIT watch. You can go in there. This is the other document that we'll be sharing. This is monthly REIT data there. You can find it in here as well, or you could just type into Google NAREIT investment performance by property sector, and you're going to find it. So we're going to start there. And look at some of these property types. Now, so we'll start with industrial. Now, industrial properties, so we're thinking warehouses, thinking things like that, factories. These have done really well, especially the warehouse property type over the last 3-5 years, just because as that shift to e-commerce, especially during the pandemic, that shift to e-commerce really juiced those warehouse property valuations, right? You have to, anything you order from Amazon or anything you order online, it's got to be stored somewhere in a warehouse before it gets to your home, right? So these industrial properties have done very well over the last few years, down 28% last year, but already up 9% this year. So they've already started to rebound pretty well, and this is much closer tied to the economy, right? So if we do see some economic weakness, economic recession even towards the beginning of next year, industrial properties will probably suffer a little bit. But again, you've still got a pretty strong valuation or pretty strong upside in those. So we'll look at a few industrial property REITs there. Office space, obviously the big loser last year and this year, down 37% last year, down 16% this year. It's the worst performing property type this year and last year, even worse than retail, which retail has been the the dog for property types over the last few years easily. Write-downs will be needed. There are going to be a lot of urban air parks where the buildings stood over the next couple of years, but this could be eventually this will be the best performing sector. Okay, maybe you wait until very late this year or early next year to start looking at some of these office REITs types. Like I know Boston Properties, we can look at that one. We'll look at a lot of these REITs in this property type later, but maybe you wait a little bit later to start looking at some of these office property REITs. But again, the hardest to fall is always the strongest rebound returns when it does eventually rebound. And again, this will eventually rebound. Obviously, those asset valuations will get marked down. We will always need office space. I can tell you, as somebody that has worked from home for more than a decade, worked from home since 2013. Even I rent out office space every once in a while just to get back into some sense of normalcy to those old days of being in an office. It's great to be able to work around other people and things like that. So even as we shift to more of a work from home environment, we're always going to need that office space, especially the corporations and things like that. So eventually those office property prices and valuations will drop to a point where the rebound will be there. Retail down 13% last year, down this year as well, just 0.62%, but still down this year. Also, shopping malls, regional malls, really being hit hard by that shift in e-commerce. So that's one that's going to have longer term headwinds. E-commerce is still just 15% of the total retail sales market and growing every year. So that's a long term weight on retail property. I'm not quite as bullish on retail property as I am on, office space eventually, and some of these other properties. Obviously, you can still get some very good returns if you find the right one, but I'd be more hesitant and more reluctant to invest too much in retail property types. Residential. We see residential property types between apartments, manufactured homes, and single family homes down 31% last year. So a big drop last year on those interest rates, but up 9% this year, and especially apartments up 10% this year. Single family homes up 18% this year. So this has already kind of started to increase. We have a record apartment construction coming available this year. We can see this. Record apartment construction volumes across the U.S. coming online. We had record construction last year, and that's all coming online. It says over 917,000 units currently under construction. Of course, again, this was last year, October of last year. So those are all coming online, for rent this year. That's about 5% of the existing apartment base. So we are seeing a huge increase in apartments coming available for rent. But the demand is still there. The demand for apartments, for residential construction, single family homes is so tight after a decade of underbuilding. A lot of people don't understand the real pain that the residential housing market went through that 2008, 2009 crisis. We were underbuilding residential homes for more than a decade, and that is just now, really catching up with that. So even with this record apartment supply coming online this year, we're still underbuilt as far as residential. Now, and another thing that is really supporting residential property is the fact that more than half of home mortgage owners, so single-family home mortgage owners or condo owners, have rates locked in even under 5%. Okay, so until those rates come down, until mortgage rates come down to under 5% even, you are going to have a serious amount of the supply just not coming back on the market for sale. Because why would you sell your home with an interest rate of 5% or less only to have to take out a new mortgage or rent? Take out a new mortgage for 7 or 8% or just rent. Okay, so we still have a historic low of homes available for sale. So that's why I think not only should residential apartment rents should still do well, single family homes should do well, and home builders should actually do very well over the next couple of years. Obviously, the only way until we get a steep decline in interest rates, and not even through next year, we're talking even into 2025 and beyond, it's going to take that long for the interest rates to come down enough that homeowners are going to start putting their homes up for sale to get for those interest rates to come down on mortgages. mortgages. It's going to take that long for that to happen. So the only way to get out of that tight home supply, that tight residential supply, is for home builders to build us out of it. So I think the home builders are going to do very well, and the valuations on apartments and single family homes are going to do it well as also. So we'll look at a few residential REITs also. The lodging and resorts property type down 15% last year, up about 4.5% this year. So outperforming the overall REITs, outperforming obviously office and other space. But really, surprisingly weak. The hotel and lodging space has been surprisingly weak. Again, it's a lot of the business travel that has dropped off since the pandemic, really hurting those hotel revenues. It's a lot of the interest rate rise is most of it, where the interest rates have run so high that those properties are not cash flow positive anymore, and they're letting those go back to the lenders. They're really the hardest hit beyond office space, it appears. But recreational travel is still extremely strong. If you look through a lot of these recent earnings reports by the airlines, by Delta, by United Airlines, the resident or recreational travel and tourism is still very strong, still really supporting those airfares and the airlines. So you got to kind of think that helps the hotel business and lodging business as well, if that tourism continues to remain very strong. So I'd be looking at lodging and resorts as well. I think that's going to be one of the biggest beneficiaries also when interest rates start coming down here next year. So we'll look at a few of those. Healthcare here down 22% last year, up 7.8% this year. Okay, so the rebound has already started, as evidenced by the 40% run in shares of medical properties trust just over the last 2 months. So this is one that we've talked about quite a bit here on the channel. Pays a really nice 11% dividend yield that is covered by free funds from operations. $1.16 paid out each year from for that dividend. Funds from operations this year, management says is going to be about $1.60. So very much covers that dividend. And those shares are up 40% just in the last 2 months. It really rebounded from this 22% decline in overall healthcare last year. It was a massive decline in MPW last year. Now, a lot of this office space, obviously office healthcare space is still weak, but the facilities are getting much stronger. And that's really what's helped MPW, a lot of these other stocks, is that besides the higher interest rates that have really hit this property type and all property types, is that Medicare and government reimbursements for patient visits and for healthcare services did not keep up with inflation. So it really hit the profitability of a lot of hospitals, other facilities, healthcare facilities out there. And that's what really hit the space for these healthcare REITs, for these healthcare real estate owners like MPW. The tenants just couldn't pay the bills because the reimbursements for those services weren't there. We are starting to see that turn around this year, late this year. So those reimbursements are increasing along with the pace of inflation. Those balance sheets and income statements are getting better for the facilities themselves, for the hospitals themselves, and that's flowing through into the office space owners, or not the office space owners, the facility owners like MPW, right? So, obviously this one also has some very strong long-term demand characteristics for healthcare. We're only getting older and we're only paying more for healthcare. So this is one of the ones I focus on. I've obviously got a big position there in MPW, but we're going to look at some of the other healthcare REITs as well. A couple of the last ones we'll talk about, then we'll look at individual REITs and how to find those. But we've got infrastructure or self-storage down 26% last year, up 9% this year. So this one has already started to rebound as well. Self-storage is always one that's kind of confused me, how strong it is. It was one of over the last couple of years before 2022, it was one of the best performing property types. Returns of like 30% a year. And that demand, that strength has always kind of confused me. But people love to buy shit and pack it away. I don't know why they pay so much for self-storage, but they do. This is a much lower management intensive and maintenance, much lower maintenance than other property types. So you get much better cash flows with this property type. And of course, we're actually starting to see some big deals come through for those property types for self-storage. Blackstone just announced today that it was going to sell its storage business. I think that's like Simply Self-Storage is the name of Blackstone's $68 billion real estate investment trust. Simply Self-Storage here, selling for $2.2 billion to public storage. So we're already seeing some bottom feeding there in self storage, picking up some deals on those valuations, and that's why that's rebounded 9% already this year as investors are coming out and seeing those low valuations for self storage and for some of these other property types and snapping those up ahead of next year's rebound in these properties and REITs because of those cuts. One more here, the data centers, 28% down last year, up 19% this year. This is, by far really the strongest property type this year, that data centers. I think it's obviously getting a big boost from the AI frenzy. Obviously, those AI chips, nothing if it can't, if that data can't be stored on servers. Okay, so all that data explosion that we're going to get from the Internet of Things, from AI, from self-driving, all that over the next few years, that data has got to go through servers, and and that's all going to be stored in these data centers. So even the idea that these have rebounded by 19% so far this year, I think there's still many years of very strong long-term demand for these. So we got the property types that we're looking at. We got the ones that we might want to avoid for a little bit longer. Office space, I think more pain, more weakness to come. But a few of these looking really good as far as how they've done, just over the past year. And so I want to go back to this NAREIT REIT Watch data. Okay, so again, you get this right from the NAREIT website, REIT Watch. It's a monthly report of the REIT industry. And if you go down here to, I believe it's page 36 is where these start. A lot of good information here. But on page 36, it starts a REIT by REIT breakdown, or property type by property type breakdown. And it's really small, so I'm gonna try to enlarge it here a little bit for you to show you. But we got each property type, right? So it starts with office. It has all the REITs in that property type, and then the average amount. So this is a really great resource to look at by property type. So which property types do we like? Which ones do we want to start looking at? And then the individual REITs in there. If you go over here to FFO per share estimates, so this is going to show you the growth. Okay, well it just shows you right flat out here the FFO growth percentage, the percentage of growth in funds from operation expected in each of those, as well as across the entire property sector. So across, for example, office property here, we're expecting an average decline of FFO, average decline in funds from operations of 11.5% in that 2023 to 2024 period. Where it also gives you price to FFO estimates for each REIT, for each stock, as well as overall. So kind of give you an idea of which stocks are cheapest, which stocks are growing. If we look at, for example, this first one here, this Alexandria Real Estate Equity, ticker ARE, we can see it's trading a little bit more expensively, quite a bit more expensively actually, than the overall market. We can see it's trading for about 12.7 times on a price to FFO basis. The overall office property sector or subsector trading for 4.9 times on that price to FFO basis. So obviously much more expensive, 3 times more expensive there than the overall office property market. But if we look at FFO growth, it is expected to grow its funds from operations by 7.3% over this 2023-2024 period. So obviously, much better than the 11.5% decline in FFO. That's just something you have to consider when you're looking through these REIT stocks, trying to figure out, okay, which ones do I want to invest in on that valuation, but also on the growth prospects for each one. You don't want to invest in the cheapest real estate stock just because it's cheap. It might have, very, very much bad, negative growth over the next couple of years, which obviously is going to be unsustainable if they want to keep on paying out these. It also shows you the payout ratio for FFO, right? So kind of a measure of stability. The lower the better here is going to be your stability in your dividends there. So Alexandria paying out 64% of its funds from operations to cover that dividend. Now that's not a problem if it keeps on growing growing that FFO by 7.3% a year. Obviously, it's going to grow that FFO. It's going to be able to grow the dividend and still stay in a reasonable area for FFO payout. Some of these other ones though, you've got some, okay, here, this Easterly Government Properties. already paying out 88% of its funds from operations as the dividend, but expected to see a negative 1% decline in FFO over the next year. So that's going to mean it's going to get even more unsustainable on that dividend. It's going to be paying out about 90% of its funds from operations to cover that dividend. That's going to leave very little room left for any kind of operational expenses and things like that. And that's what you got to work for, or what you got to look for if you're trying to avoid any kind of a dividend cut. Okay, so that's really what we're looking for in these REIT stocks. I want to go through a couple of these property types, kind of look at which property, which REITs I'm watching. We can start here with office space. Now, obviously, like I said, I think we give office space a little bit more time. There are still massive write-downs in these valuations that we need to see office before it bottoms. But I do think this is going to be the property sector to be in when that rebound occurs. Starts maybe early next year or mid next year at the latest. So you want to look at some of these. We looked at Alexandria Real Estate. That one looks good, 7%. 7% FFO growth, so they are still growing their funds from operations. That's very important. The FFO payout isn't too high, so that one might be one to watch. You look at some of these other ones. I've talked about Easterly Government Properties, that ticker DEA before. Presumably because it's mostly government properties, they would have strong cash flows. They would have strong and stable cash flows because it's government paying the bills there. But that does worry me. That 88% payout ratio and declining FFO there. That is going to be very hard for them to not even increase the dividend, but just hold it consistent without a cut. So I would be worried about a dividend cut there in Easterly government properties. Look at some of these other ones, the larger ones. I know there's where's Boston? Boston Properties is a big office space. They're kind of the proxy for the market. Boston Properties is so big, ticker BXP there, that it's kind of sometimes used as a proxy for the overall market. They are expected to do 3.4% FFO growth over the next year, down 52% payout ratio on their dividend. So it's a pretty low payout ratio. We can look at to see exactly what they're paying out as far as dividends. I know it's not high. BXP. See what we get here for a dividend. So it's still a 6.1% dividend yield. That is a pretty strong dividend yield, to be looking forward to. I think if you're looking at office properties, trying to get in on the rebound there, that one's, it's large enough that they're always going to have the financial power or the financial strength to really survive the kind of sell-off that we're looking at and the kind of pain that might still be coming. They're paying a 6.1% dividend yield. They have a very low FFO payout ratio, so you've got a more stable and more sustainable dividend right now, and they are still expected to grow their FFO even marginally, 3.4% next year. So that's a good sign, and that's one that I would probably watch there. What else? We talked about industrial properties here. All you out there in the Bowtie Nation, I love Stag Industrial. They are more of the warehouse e-commerce trend there. They're getting a little bit high, 67% payout ratio here, so a little bit higher than the average 59% for the property sector, for that property segment. So I'd be watching that, but expected to grow FFO a little bit slower actually than the average. So, you might want to start looking at something else if those are getting a little expensive. I know the dividend yield isn't very high for them. Might look at this. Might look at something like this East Group Properties. That's another industrial one. I know another big popular industrial REIT here is this Prologis, ticker PLD. It's for some reason they don't have a FFO. They might have actually suspended their dividend. Let's check that out and make sure. See, you got to look at this. You got to look at all data here you have for these. So let's PLD. So let's see what they are. They're only paying 2.8% dividend, and that's if they haven't stopped their dividend payment. So we can go here to historical data. We can go to dividends only. Apply. Okay, so the last payment so far was June of this year, 87 cents a dividend. They did increase it last year. It looks like I mean, you can see the longer term here, how often they increase it and their history of increasing it. They do have a pretty good history of increasing the dividend payout. So, they might just not have the FFO data for Prologis, but definitely one I would look at. They do seem to are expected to grow only at 2.5%, grow the FFO. So I would be a little worried about that, as well as lower dividend yield. You might want to find some of these other ones. So yeah, I would definitely check out East Group Properties, as well as some of this industrial space. They're going to be a little bit more into that e-commerce trend and economic growth once economic growth does pick up. We can go down here. Shopping centers, I would avoid shopping centers, regional malls, this retail space. I don't know. It's always just been a hard property type to get excited about, just with that long-term trend away from retail shopping and into e-commerce. You're always going to have the headwinds against that. Obviously, we still like going to malls, still like going shopping as a family event and that kind of thing. But you're always going to have that headwind from the e-commerce, e-commerce growth. So, I would avoid some of those. I know Realty Income is still a very popular REIT, and that's mostly the convenience stores and the less e-commerce sensitive stuff. So that one can still be a good one. We're looking at residential here: apartments, manufactured homes, single family homes. Not a whole lot to choose from single family homes. Apartments, you've got more. You've got big ones like UDR and Equity Residential, ticker EQR, the big players in the apartment space. And again, so you're looking through here, you're looking for lower payout ratios, ratios that, this apartment income REIT right here, ticker AIRC, already paying out 78% of their FFO to cover that dividend. They do have about a 5.8% expected FFO growth over the next year. That's below the property sector average. So I would probably be a 1-2 strikes against it right there. High payout ratio, low FFO growth compared to the rest of the property types. So that would be 2 strikes against that. I would want to check out maybe the dividend, see if that's high enough to kind of incentivize me to take a chance on that, as well as some of the other research that I might do on that. But if you look in through here, you've got Camden property, only 54% of that FFO is going to pay the dividend. So it's much more sustainable, gives them much more room to increase that dividend and not be in danger of spending all of their funds from operations just to cover the dividend. You've got other ones here, extremely high, 81% there for Elm Community. It seems overall, apartment FFO payout ratio is higher than some of the other ones, 65% here. But you can find some that are quite a bit lower and still leave some room for payout ratio to increase there. You've got single family homes, American Homes for Rent is probably the bigger one here, paying out 47% of their FFO to cover the dividend. That's not too much. 6.7% growth expected next year. What other property types? I want to look at diversified. I want to look at lodging and resorts here because, again, I think this is very much a interest rate sensitive theme that we're going to see turn around. It's been hit hard over the last year. We see this Ashford Hospitality Trust here, ticker AHT. They're the big ones that are expected to let 19 properties go back to the lender. We're saying, no, we don't have a payout ratio there, so we'd want to check that, see why we don't have a payout ratio for FFO, see what their FFO is. Their FFO may be negative this year because of because of some of the troubles they've been having. 42%. Wow. Expected 42% increase in FFO over the next year. So that's obviously something that we'd probably want to look at. Why are they expected to rebound so quickly and so aggressively into their FFO? They might just have had such a bad year this year that it might be time to look at this stock. So let's look at AHT. I know it's probably done pretty poorly over the last year, just as they do have problems in their hotel space, down to $3.77 a share. This is only a $137 million company right now, market cap. So over the last year, it has fallen from $8.72, fallen more than 50%. It does look like they may have suspended their dividend in these troubles, but the 1-year target estimate is $11.83. So maybe something, if you were expecting that increase or that rebound in hotel properties, and I am expecting that. Obviously, there could still be some more pain to come in hotel properties, in lodging. But if you just look at the demand for tourism, for air travel on a recreational basis, that has got to be some kind of support for these hotel stocks. Okay. So definitely be looking at some of these hotel and lodging stocks, starting with Ashford. You might go here to some of these. I know Host Hotels is always a fairly large one. Again, here Host Hotels, ticker HST, only paying 27% of their funds from operations for their dividend. So a very strong, sustainable dividend there. Only expected to see about 2.7% FFO growth. So I would want to see, why is the FFO growth expected so much different from Host Hotels versus some of these others, versus Ashford Hospitality and versus some of these others. So this, some of the ideas, some of the things you need to consider when you're doing your research for these, but definitely be looking at the hotels over the next year. Self-storage, again, this is one that continues to confuse me why the demand is so strong for self-storage, but it is very much cash flow positive and very strong cash flow because of those less management intensive and less maintenance intensive. They tend to pay out much higher portion of their FFO to dividends just because their maintenance expenses and their management expenses are so much lower, so they can afford to pay out much more of that FFO, those funds from operations, to satisfy that dividend. You got 64% here for CubeSmart. You've got Extra Space Storage here, 71%, but they are expected to grow their FFO by 6%, by 5.6% on average over the next year. So those are kind of a stable growth rate there. We talked about infrastructure, these cell tower REITs like American Tower, AMT, as well as Crown Castle, ticker CCI, SBAC, ticker SBAC, SBA Communications. When we talked about AT&T, Verizon, some of the problems they've been having with lead cables, I don't think that's going to affect these cell tower REITs. Okay, I could be mistaken, but I don't think they have any kind of responsibility for these lead cables that are all over the country, whether in the air, or buried, or in the water. So I think maybe the sell-off in them has been a little bit overdue. Still, though, you do see some of these with extremely high FFO payout ratio. So I would avoid anything with 112% FFO payout ratio. That is clearly an unsustainable dividend right there in American Tower if it is 112%. Data centers, not much of a choice here. Digital Realty Trust, which I actually do own shares of Digital Realty Trust, ticker DLR. So full disclosure there. It hasn't done that well over the last couple of years. But I do really like the long-term trend in those data centers. So you might want to look at Equinix here, ticker EQIX. I've done a video on that quite a few years ago, and that's a good investment as well. So look at those. What else? So I think we have just medical spaces left, and then we'll open it up to question and answer. Actually, we must have missed medical, healthcare. Home financing, specialty, timber, self-storage, lodging, healthcare. Okay. So healthcare, last property type I want to talk about, then we'll turn it over to question and answer. Okay. Here we have Medical Properties Trust, ticker MPW. Obviously, one that we've talked about quite a bit on the channel. Now, this says FFO payout ratio of 138%. That is not right. Maybe that's a backward trailing 12 months. I know their FFO did take a couple of hits there in a couple of quarters, but management expects FFO to come in at $1.60 per share over this year. That would be, here we see this FFO 2023, 2024 expectations. So expectations by analysts expected $1.57, $1.59 FFO at Medical Properties Trust here over the next 2 years. That would more than cover the $1.16 in dividends. So you can't always just take the data here on face value. Sometimes you got to recheck it. Got to check the outliers here. That is not 138% FFO payout ratio. It's actually, if we take this $1.16 payout, $1.57, so $1.16 dividend, or $1.16 dividend payout for MPW over the year, divided by $1.57 expectations for 2023 FFO. That is a 74% FFO payout. Still on the high side, still something I would want to watch, but certainly not this 138% that they're telling us here. So you do definitely want to recheck some of these numbers sometimes to make sure that you're getting factual data. A little bit lower FFO growth. Obviously, MPW has had problems with its two largest tenants, Steward especially, but it is developing out of those. It's Steward sold, I think, 6 properties just over this last 3 months, using the proceeds from those property sales to pay off a lot of the debt it owes MPW. It's also MPW is also transitioning away from these larger tenants, and again, we're starting to see really good fundamentals come back for these hospitals themselves, for the facilities, where they're able to better pay these healthcare REITs, these healthcare owners. So I'm in Medical Properties Trust. You can also look at some of these. Some of these you got to understand are different between. So LTC is long-term care. It's mostly that senior housing versus MPW, which is going to be more of the facilities, the office space, things like that. So you do need to know even within these property types what the different property uses are within these. Care Trust REIT, we've covered that one before on the channel. Global Medical REIT, that's another one I've covered that I like. Ticker GMRE. That one. So you might look at that one as well as some of these others. Sabra Healthcare REIT, ticker SBRA, is another one. So that's just kind of what I'm thinking about in real estate. I know it was a long way to go on these, but that is just kind of the research and the analysis you need to be thinking about when you're thinking about the property stocks as well as each property type. You need to start with, okay, what's the outlook for the overall REIT market? Okay, why has it been hit so hard over the last year? Why has it underperformed so far this year? The effect of interest rates on those properties and why that might turn around, when that might turn around. So you start with that big top-down picture. You go to, from there, you go to property types. Which property types have been hit hardest? Which ones might rebound first? Which ones might take a little bit longer to rebound? And then you look within each property type into the REITs within each of those. And that's really where you need to start with taking advantage of what I think will be a very strong 2024, 2025 market for a lot of these real estate and investment trusts. I want to go back to turn it over to our question and answer, my favorite part of the live stream, just to kind of connect with all you out there in the Bowtie Nation and see where you're at. So I'm going to scroll up here and see any questions. If I don't see your question, make sure to ask it in the chat there. It's going to make sure you use the question mark so I see it is a question. I have pinned one comment up there in the chat. Help support the channel. Click through that. It takes you to a free report that I did with the Motley Fool. Shows you my forever stocks, the stocks I'm buying for the next 30 years. Just kind of a list of some of those long-term ideas that I'm watching for stocks to buy. It's a totally free report. They'll ask you to put in your email there. Motley Fool is going to send you some emails asking you if you want to use the Stock Advisor, tool. I've used it in the past. I like it, but there is absolutely no obligation. Okay, so click through, put in your email and get that free report. It's going to give you that first stock right on the page there, and then it's going to send you in your email. So check your email, check your junk file just in case it goes there. It's going to send you the other 4 stocks as a report from the Motley Fool. So be looking for that, in there. But it helps support the channel, so I appreciate that if you click through and sign up for that. Going to look through some here. I see a lot of members from the Bowtie Nation there. A lot of long-term members. Ambrose from New York there. Good to see you there. Melanie there in Seattle. Good to see you. It's great to see everybody from all over the world here in the Bowtie Nation. Melanie says, shocked that we're within 6% of the all-time high in the S&P 500. It has just been a crazy year for stocks. I think we're right in that kind of Goldilocks scenario, right? Where inflation has come down enough that even if we do get economic weakness later on this year, early even next year, as the economy continues to adjust to these higher interest rates, I think that inflation coming down is key here, that it's still going to, the market is still going to be supported by the idea that, as we saw, the Fed is going to cut interest rates next year, going to help support the economy, going to help bring back the economy and stocks. And so I think even as we start seeing the economy weaken further, I think you still see the stocks run into that bull market, that next bull market here. just because they had that support from the idea that eventually the Fed is going to come to the rescue. Okay, we couldn't have that before inflation really started proving that it was coming down. We couldn't have that because there was always the possibility and the potential that the Fed would have to continue to raise interest rates even in the face of economic weakness and just destroy the economy, just destroy the stock market just because inflation was high. But now that inflation is definitely coming down, then I think I think we're right in that Goldilocks moment where even bad economic data just means that interest rates cuts are coming even sooner and going to support a lot of these stocks that we're talking about. Ron has a question. What are your thoughts on Fundrise? I've used Fundrise in the past. Actually, just cashed out of my Fundrise account just over the last couple of months. I didn't like that I had to wait like 3 months to get my cash out. Basically, with Fundrise, you invest and it's a closed fund, right? So you invest, and when you want that redemption, when you want your money back out of those funds, then they have to approve it, and they only approve redemptions like every 3 months or something. So it was a fairly good return. It was a positive return. I think something like a 6-7% annualized return for me over the last 3 or 4 years that I've been in it. So it's been a positive return. Obviously hasn't kept up with stocks. And I kind of wanted to consolidate some of my stuff into just real estate stocks that I own directly rather than being on Fundrise. So, it's a good platform. It's an interesting platform, and I love how it gets you deeper into that real estate investing to where, the whole portfolio is only maybe 30 or 40 properties, and you can really look deeply at each of those properties. But it just wasn't for me at the moment. I think these real estate stocks, you pay no management fee for those. You can fine tune your investment as far as property types with these REITs. So I think, anything you can do on Fundrise, you can really kind of do with these REIT stocks anyway. So I would rather just invest directly in the REITs rather than, through a portfolio there. Changing your analysis on APE after, Daniel wants to know, have I changed my analysis on APE, ticker APE? So the preferred shares of AMC. And I want to look at this. Let's turn it over here. Actually, I was almost going to change the live stream to cover this instead of real estate stocks because, when I saw that news on Friday. So if you hadn't seen, on Friday, the judge denied the settlement between AMC, the company, and AMC shareholders. Okay, the AMC, the company, AMC Entertainment, created these preferred shares, these APE shares last year, September, I believe, last year, with the expressed intent to convert these into the AMC shares of AMC, right? For a 1-to-1 basis, right? So one share of APE was worth one share of AMC. In fact, the way they did it, all the AMC shareholders back in September, they got, for every share of AMC they got one share of APE. Okay. So the idea was to raise money back then, get them out of, any kind of bankruptcy problems, but then convert these APE shares back into AMC. So since then, starting in December, then I've started investing in shares of APE on the idea that once these convert, they are going to be as valuable or close to as valuable as the shares of AMC. And you can see here, shares of APE are only $1.76. Shares of AMC here are $5.16, even after today's big 12% sell-off. So there is an arbitrage opportunity, and a lot of people have been playing the arbitrage opportunity where they sell shares of AMC and use that as to funding to buy APE. Now that has not worked out here in the past week, because that settlement was denied. A lot of AMC shareholders came up and said, no, we don't want this conversion to go through. We don't like that conversion. And last year the company did have an investor day where they held a proxy vote on the conversion. They did get the go ahead on that conversion. Let's see if I can refresh this. That conversion was voted in approval for the shares of APE. The shareholders of AMC then sued the company to stop the conversion. That was denied. That was finalized here on Friday with the judge saying that no, they could not approve the settlement. Now, what's important here and why I wanted to invest more in shares of APE. I invested at $1.52 in March. I want to say it was earlier this year. I invested at $1.52 per share. It was right around here, March. I did the video and invested $10,000. I think it was $10,000 at $1.52. I ended up selling at $1.92 here in here in July, early July. Sold at $1.92. I wanted to get back in these after that settlement, because directly after the settlement, or after the litigation, after the judge denied the settlement, then these were down to like $1.44, and the shares of AMC were up, something like 77%, up to like $7 or $8 each. I wanted to invest because what you got to understand, folks, is AMC Entertainment, the company, is just wrecked without new funding, restructuring their debt. They are not going to be able to stay out of bankruptcy unless they get more funding, unless they get, some kind of a leniency on their rates. And they can't do that with these shares of APE out there. Okay. A lot of, obviously preferred shares, they have stronger right structure than the common shares. With this kind of preferred shares, and the overhang in the conversion, they have a real overhang, or a real weight, a real headwind against them when they're trying to raise new debt, right? And they're trying to restructure their old debt. Okay, they can't do that with these shares out here, right? So a lot of what the company is saying is that, yeah, even though Barbenheimer did $300 million in ticket sales this last weekend, the theater business is still a train wreck so far this year, and they need to restructure some of this debt. They need to get new debt to cover it, things like that, and they can't do that with this conversion still overhanging the stock. Okay. These APE shares were created with the expressed intent to convert. So they are going to be converted. The company can't just let these preferred shareholders hang out in the wind forever. Okay, there will not be APE shares forever. Okay, these will be converted. It's only a matter of the settlement that sounds fair to the AMC shareholders as well, and a settlement that can be approved. Okay, again, we already had approval of that conversion here in December. I think it was. Some AMC shareholders came back and sued to stop it. They were, they got the upper hand this last Friday, but there's, the difference here, I think, is in the minutia. I think the company, they already proposed a new settlement process, or a new settlement terms on Friday just after that. That's why these shares of APE only went down like 2%. They were only down over the last day to, as low as $1.68. Okay. Not anywhere close to where, I wanted them to drop so I could pick up shares once again. So I didn't pick up shares. I think, if you're still holding them, I think you can still hold them till at least $2 a share. I sold at $1.92 earlier. I think you can hold them till at least that point, or $2 per share. I think they get back up there pretty quickly as this new settlement is worked through and eventually the conversion goes through. I think eventually, when that conversion goes through, I think these do go to maybe, $3 a share, $2.50, $3 a share. I think you can still make very good money on these. I would like... Hell, I mean, if I could get these back down to $1.50 and buy them back in again, then that would be great. I don't think they're going to get there though, because because of the clear idea that these will be converted eventually. The company just needs to find some kind of a settlement, just some kind of conversion terms that work for all properties here. So, again, I would stay in here at least until about $2 if you own the shares. I would probably be more confident and get back in the shares if they were right around $1.50 or so, because I do think they go pretty close to $2 or even above, here over the next couple of months. What else? What other questions do we have here? Hold XLRE. So yeah, Vape King says he holds the XLRE. That is the S&P real estate investment fund. Okay, so we talked a lot about the real estate stocks, the individual REITs here. You could always go with something like the XLRE that holds all the real estate stocks in the S&P 500. So a lot of those really big companies, and you're going to get the best of both worlds here. You're going to get the rebound eventually in a lot of those sectors. You're going to get some good office rebound in there when those rebound, but you're also going to get the data centers. You're also going to get the healthcare REITs that are already rebounding. This one does pay a little bit lower, 3.7% yield, so a little bit lower dividend, but it's going to be safer than maybe some of the individual REITs, because it's spread out, it's diversified across all of those. What else? Ooh, Naranjan points out that the thumbnail for this looks like 9/11. That is not what I intended. I'll have to go back and maybe change that because I don't want that thumbnail to remind anyone of that. What else? SLEG. Okay, so Ronald Reagan, good to see you here, back from the dead. Ronald Reagan here in the chat says SLG is doing well. Manhattan office space, 10% dividend. Okay, so yeah, I mean SLG is one of the larger office property owners. SL Green Realty. They are deep into New York real estate. But they're having all the same problems that a lot of the other office properties have. You see, it's here just over the last year, down from 50, a low of 20 here in March, but it has started to rebound. And this is what I'm talking about. We're talking about those interest rates coming down starting next year, but these property types will rebound before that. The distressed debt investors, the bottom feeding investors, they're going to be looking for those deals. Hedge funds are going to be getting in on these, at these bargain basement prices. So some of these have already started to rebound. This one's 36. Let's look at what it's done over the 5 years. So it's, it did fall quite a bit even since before the pandemic. So New York real estate, not so sure it's quite healthy just from this chart. But I think you could easily over the next 5 years see it rebound back to even $60 a share here compared to 36. That would be almost 100% return. Even if it's just back up to $60 a share over the next 5 years or so. 10% dividend yield. I would want to check that against the payout ratio and expected growth here that we've got. So we can go back to this NAREIT chart or this NAREIT data. Go back up all the way back up here to office space. And if we look for SL Green, okay, SL Green. So expected to do 3% FFO growth next year. So positive FFO growth is always good, especially compared to the rest of office REITs that are expected to decline 11.5% in FFO, paying out 64% of its FFO as a dividend. So fairly sustainable, a little bit on the high side compared to some of these others, but not bad. Price to FFO, it is trading right around the sector average, 4.2 times FFO, 4.1 times on a 2024 basis. So fairly cheap, decent, expected FFO growth, lower FFO payout ratio. So yeah, definitely one that I would look at further as far as possibility, especially in that kind of eventual office space rebound. What else do we have? Matt. I do Uber as a side job. I'll tell you right now that people don't have much money. Grocery stores are packed though. So yeah, just Matt's talking about I do Uber as a side job. Tell you right now, people don't have much money. We are definitely seeing a slowdown in consumer spending. That is definitely going to come through the rest of the economy, and the economy is weakening, folks. We're going to see it. We're going to see the economy fall more before it gets better. But again, I think we're right in the Goldilocks area where even lower economic growth only means that the Fed is going to be able to cut rates sooner rather than later. So I think that is going to continue to support stocks, and why you don't have to be worried too much about a recession destroying the stock market. Okay, Andres wants to know who are the leaders in data center REITs. There really aren't a whole lot. You got that digital realty. You got Equinix, ticker EQIX. Again, I own Digital Realty, ticker DLR. These are just kind of good long-term growth real estate investment trusts. Okay, we've got that long-term demand in data center demand. You've got with Digital Realty Trust, you got a 4% dividend yield, not the highest among REITs, but pretty stable 4%. It's a fairly decent dividend growth, and one you really kind of don't have to worry too much about, right? It's going to be affected by interest rates. We can see here that it was hurt by interest rates, but has basically already recovered most of its loss that it suffered over the last year because of the interest rates. Okay, that's just the kind of demand that we're looking at in data center REITs that is going to support the prices for these data center REIT stocks. Okay, what else here? Thoughts on office space conversion to multi-unit. So Andrew wants to know about conversion of office space into multi-unit apartments. Again, I think it's kind of a pipe dream for a lot of office space owners out there. Obviously, some of them are going to make it work, but it is very expensive to convert office space into apartments. Just because, I mean, if you look at the demand, okay, are we going to turn all the office spaces into these large urban areas into apartments? Why? If there isn't, why would people be want to live in the cities if they're not working there anymore? So you've got a little bit of a demand problem there, but just on the cost basis for converting these office spaces. You look at an office space, it's got, windows that need to be completely changed out because they don't open or they don't open correctly in terms of building code for apartments. They don't have the plumbing or really the electrical, or more or less the plumbing really is mostly. They don't have the plumbing that keeps up with code for office space or for apartments. So very difficult, very costly to convert office space into unit apartments. Obviously, if office space valuations just crash through the floor, then it'll make it a little bit more attractive to convert those. But I think it's going to take a while to be able to see that. I don't think that's the savior of office properties that some people might think it might be. What else? What others do you like? V&Q. So the Quags wants to know if I like V&Q. It is one of the other possibilities. If you just want a broad exposure to the real estate market, that is the Vanguard Real Estate Trust, right? The Vanguard Real Estate Index Fund, just like the XRL. Just like the XRLE, right? The S&P Spider Real Estate Fund. This is going to own all the REITs in that index. So it is a very large fund, $62 billion in net assets. They're the Vanguard Real Estate Index Fund, V&Q. It tends to skew a little bit more heavily to office properties. So, obviously, if office properties do eventually become the big rebound story for real estate, then I think the V&Q will do very well. But it's tended to underperform because office property has underperformed the rest of the market. So just something to think about. 4.5% dividend yield, pretty decent. It's not the highest you can find in REITs and individual REITs, but again, it's nice to have just one fund where you get broad exposure to the entire real estate market. I'm going to scroll down here, see if and make sure. Let me know if you're seeing, hearing me all right. It seems like the latency on the computer has come down, or it seems like the bandwidth has come down enough, but I want to make sure I'm still coming through. So let me know if you can still hear me, see me all right, if it's any kind of a lag or something. What else? Scroll back up here to see what other questions you have. Should clarify, new homes are built, smaller properties. MPW. So Alan says he got MPW at $8.50 average. Yeah, $8.50 now. It's trading for above $10, right? Above $10 a share. So pretty strong 25% return for you there over the last couple of months. Very strong return. I'm still in MPW. I still like it for a long-term play. 11% dividend yield right now, and stable dividend. Okay, Gergana, do you think that TWO, that's Two Harbors, it's a mortgage REIT, will rebound in 2024? Is it worth holding or buying at $13.50 USD? Okay, so Two Harbors. Now, this is something we didn't talk about really. Two Harbors Investment, ticker TWO. It is a mortgage REIT. So this is a completely different part of the real estate investment trust market. Okay, these mortgage REITs, they don't own the physical property themselves like most REITs, like we've been talking about. They own mortgages, right? They will borrow short-term rates, or they'll get their funding from short-term. They'll borrow on those short-term rates and then leverage that up 3 and 4 times to buy these mortgages. So the real problem with in mortgage REITs that we've seen over the last year or two has been the yield curve. Okay. Because imagine that. Imagine if a company, it has its funding, but then it borrows to leverage that funding up 3 or 4 times. It borrows on those short-term rates. So it's paying, on the, maybe let's say a two week rate or whatever. It's paying that here. Now, usually with a healthy economy, growing economy, long-term rates are going to be up here, and mortgages that are based on those long-term rates are going to be up here. So if it's investing at these rates and getting those long-term mortgages at 8 or 9% interest rate, and it's paying down here at like 2 or 3% or whatever on those short-term mortgages, it's making a big spread. It's making all its profit here in the middle in this spread. Well, what's happened over the last year is that the yield curve is pretty much flat. Okay. So the yield, the interest rate on short-term notes, treasury notes, is pretty close. It's actually higher than the long-term notes. Okay, so the 10-year, the 2-year, I think the 2-year treasury rate is right now something something like 4.5%. Okay, and the 10-year is down here at like 3.9, 3.8%. Right. So the mortgage rates based on those long-term rates are pretty low. Even though they're high for individual cases, right? If you're trying to get a mortgage, you see how high mortgage rates are right now. But if overall your mortgage rates are only about 6% and they're having to borrow here at this 4 or 5% rate on those short-term rates, they're not making much of a difference. There is not much of a gap, spread in those rates for those mortgage rates or those mortgage REITs to make any money. So that's really what we've seen in this Two Harbors Investment Corporation, in a lot of the other mortgage REITs. That's one thing you really gotta worry about, okay? And you really gotta think, okay, is the economy going to turn around, and will we have higher long-term rates? Okay, that's going to bring back that spread between long-term and short-term rates and bring back that profitability in these mortgage REITs. Now, so eventually. So I think obviously if we do see a recession here in the later this year, early next, I think that's going to bring down those long-term rates. Obviously the Fed will start cutting its own rates, so that'll bring down the short-term rates. But I think you're still going to see that kind of yield curve weakness, that yield curve flat for at least another year, and you're going to see the problems extend or continue in these mortgage REITs. Now, that being said, some of these mortgage REITs like AG&C, like Two Harbors, they are so big and they are so well capitalized, they're not going away. You're not going to see them default or bankrupt or anything like that. You're still going to have the stock for an eventual rebound, and it pays a 13% yield. So it's a nice yield. That might come down a little bit if they cut that dividend, if they find that their dividend sustainability is in question a little bit. So, what I'm saying, I guess, is just, expect more pain to come in these mortgage REITs, these AG&Cs, your Two Harbors, ticker TWO. Expect more pain to come. If you're willing to hold on, through the next couple of years, then I think you will start see them rebound a little bit. You will see some decent returns, and you'll see, good dividend yields as well. So just don't get panicked out of these if you do invest in them. By the same token, don't invest in them just because that high yield, because that can always come down with a dividend cut. One thing you also need to understand, of course, with any dividend stock is that you're paying taxes on that dividend. Okay, so if the entire upside to a stock is in that dividend yield, and you're losing 20% of that or more in taxes, each year, then you got to adjust that for those kinds of return expectations. Maybe you want to be in some growth stocks as well, where you don't have to pay taxes on those dividends every single year, and you get some of that longer term capital gains returns. So just something about these those high yield stocks to consider, that you are losing some of that into you are losing some of that high dividend yield to taxes every year. Okay, Benny wants to know what I think of Comcast stock at recent valuations. Now, I haven't looked at Comcast specifically. I do know that TV is in trouble. TV, obviously the streaming services are eating TV's lunch. More of the traditional TV advertising and sponsorship is going to the streamers, is going online to TikTok, YouTube, things like that. So TV and TV, obviously TV owners, the media owners like Comcast having a real difficult time in growing those earnings and growing that. When you start hearing about Disney talking about selling its ESPN unit or taking on a partner to sell part of its stake in ESPN, there's something wrong with TV, right? Because that is, for many years, that's like the jewel of Disney's valuation or Disney's assets is ESPN and when it's considering that the weakness in ESPN and across the TV spectrum is really really forcing them to consider strategic alternatives for that, then you gotta kind of wonder. If we do look at Comcast specifically here, ticker CMCSA, we can look at a 1-year chart. Has actually done pretty well over the last year. It's rebounded there from last September. The rest of the market seemed to fall pretty heavily with the rest of the market there, and then rebound along with it, paying a 2.7% dividend. Again, I haven't looked at the fundamentals here as far as growth and growth expected. We can do that in analysis. You can see kind of the sales growth expectations as well as the earnings expectations. You look here in analysis, you see here earnings are expected to be flat, basically flat from last year, $3.64 a share, $3.63 a share this year. It is expected to grow marginally to $4, about $4.07 a share over the next year, according to analyst expectations. Of course, those could always be wrong. But if you look here at sales growth, revenue estimates, you look at sales growth year over year, expected to lose almost 1% in sales this year, 2.6% sales growth next year. So obviously, very slow growing industry, which is always one strike. It's hard to find a good stock winner when the entire industry is suffering that much. Okay, unless I don't see any kind of data or any kind of a reason to believe that the TV market is going to experience some kind of a resurgence, right? Is going to be able to become what it used to be. So you're always going to have very low sales growth. The only way to get earnings growth from that, of course, would be just to drastically cut expenses, drastically cut, what the company is paying out to be able to boost those earnings and the stock price, right? Because, of course, remember, as a stock owner, you want to see those earnings go higher because that's your ownership. Okay, without higher earnings, you have you just have no return. Okay. Even if I guess they could pay out all of those earnings as dividends and you would have some kind of a dividend return, but it's going to cost quite a bit to keep the company going. So just something I would think about with Comcast and really any TV kind of stock. What else? When borrowers make decisions to return property to the lender, how well positioned are these lenders? In other words, so Forge Till wants to know, when borrowers make the decision to return those properties, the property to the lender, how well positioned are the lenders? How beneficial is it decision for the lenders? Well, obviously, okay. So, when a REIT, a real estate investment trust, lets some properties go back to the lender, to the banks, obviously it's not a good situation for the bank because one, obviously the REIT is saying that this property isn't worth it. This property, the cash flows aren't enough to support that loan. The property probably, they can't sell the property because the valuation that they owe left on the loan isn't enough to cover, or the money they would get in a sale isn't enough to cover the loan, right? So the lenders, one, they're not in the business of taking over these real estate. Banks are not in the real estate business, so they don't want these properties back anyway. That's why you're seeing a lot of these banks kind of what they call extend and ignore. Okay, this is going to be a big theme over the next year. Extend and ignore. This is where banks are going to kind of overlook kind of the bad fundamentals in a lot of these real estate properties. They're going to try getting the appraised value as high as possible just so they can extend those loans that come due over the next year, hoping that those property valuations do come up when interest rates are cut again, and they won't have to deal with all these defaults in property loans, in properties themselves. So extend and ignore is the big buzzword in banking right now because they don't want these loans. They don't want these properties. They're not in the business of real estate. Obviously, if they're getting the property back, it's not worth what the bank, has in it for the loan. So they're going to have to take a write down there. Now, this is that's the kind of thing you got to look at on a bank by bank basis. What's the overall position of commercial real estate in that bank's portfolio? But because of changes that were made after the 2008 financial crisis, then capital solvency ratios for banks are very high. So banks are really in no trouble. If we see some kind of massive apocalyptic write-down in all commercial real estate, not just office, but all commercial real estate, then yes, that would come back and really hurt the banks. But we're not seeing that, and we're not going to see that. Anything like that, if the economy weakens that much, or we see anything like that, the Fed would come to the rescue with lower interest rates and some kind of some kind of a loan program, right? So I wouldn't worry too much about the banks and their exposure to real estate right now, as a lot of people are kind of worried about or kind of crying about. I don't think that's going to be an issue, even what we're seeing. But it is on a case-by-case basis that you really got to, if you're investing in some of these smaller regional banks, then you got to check out and make sure that it doesn't have more commercial real estate exposure in maybe a certain area than other ones. Okay, and topics for each REIT area of the market. How do you feel about AR? Okay, so Brian wants to know about ARR. That's Armor Real Estate. It's another REIT, another mortgage REIT. So we can look in here, not R, ARR, R. Okay, Armor Residential Real Estate is one we've talked about on the channel before. It is another mortgage REIT, so obviously we're going to see the same kind of weakness because of that yield curve that we saw in Two Harbors, that we saw in AGNC. But again, this is one of the larger mortgage REITs. This is the one that's going to have that financial stability, or that financial survivability, financial survivability to last through this. Okay, we will always need mortgage REITs to support that part of the mortgage market. So, it is going to be around, I would not count on that 18% dividend yield. Okay. If we look at the dividend history, I would imagine there's been more than one cut in this history, and there will be more than one cut coming for that, in that dividend. If you look here, apply, and we can see the dividend history here. Okay. So they lowered it from 10 cents a share just earlier this year in February down to 8 cents a share. It has fallen from, actually, they did pretty well. They all the way through since 2020, it was a 1 cent a share. They did lower it early in the pandemic from 17 cents a share. It was 19 cents before that. 8 cents a share paid out on a monthly basis. It's 18%. I would expect they may have to lower that again, even as it goes. Because 18% dividend yield, folks, is just unsustainable. Okay, you look at these high dividend yields, and you got to kind of really do a sanity check on these numbers. Okay, why would a stock be able to pay 18% return to its investors and still be able to keep the business going? Okay, no businesses make that kind of a return on equity to be able to pay it out consistently to its investors. So you got to do a sanity check, kind of get it back into reality here. But even if it is cut, even if that is cut down to 7 or 6 cents a share, it's still going to be a very strong double-digit yield. And again, I think these do rebound here once we get the yield curve stabilized to upward sloping again. Just be ready for that, though. Just be ready for the dividend to be cut once again. The stock price will probably come down on that, and they'll have to work through that. But if you stick with it, then you'll be able to collect those dividends over the long term. Again, you're going to lose some of that to taxes, but you're still going to do well. So this is one that I would consider among those mortgage REITs. You don't want all your money in mortgage REITs. You want some of it in regular equity REITs as well, just to kind of give you that long-term appreciation in stock price as well, and in property values. Okay, banks. What will banks get hurt due to REITs defaults? Again, you just talked about that. It's not likely. The banks have, I think. I want to say commercial real estate exposure at banks. It varies by bank, but it's maybe somewhere up 30-40%. On bank system wide. We're seeing some write downs in the office space. We're seeing write downs in the hotel space, but we're already seeing property valuations stabilize and even start coming up in some of these other property sectors, data centers in particular. So I think you don't see that whole real estate wide crash that a lot of people are worried about, and I don't think it brings any banks down, certainly. Okay, Boogie Boy wants to know: do I favor FFO growth or lower payout ratio? It's 6 of one, half dozen of the other, right? You want to see good FFO growth. I think I would probably prefer FFO growth over if I had to choose, just because just like earnings growth with a traditional company, that is your growth in the value of that company. That is your growth in your ownership asset, or your ownership exposure. Okay, your ownership in the company. Okay, as an owner of that company, you own those funds from operations in the future. Okay, as an owner of a stock, a regular company, more traditional company, you own the earnings in the future. So I want to see those earnings grow as fast as possible. Okay, so I love seeing that FFO growth. Obviously, if that keeps on going, then even a high payout ratio isn't going to be a problem, because it's growing into that dividend. It's growing into that payout ratio, and the payout ratio is going to come down, as that FFO increases, as that funds from operation keeps growing. So I would rather see a higher FFO growth, but of course, sometimes you can find one with high FFO growth and lower payout ratio, which is really the best of both worlds. Okay, how many penny stock companies, monthly, quarterly? Has anyone seen an explosion of car washes in their area? Yeah, Mark. So Mark asks, has anyone seen an explosion in car washes in their area? I haven't really seen the explosion. We've only been in here in Tampa since August of last year, so about a year now. So really nothing to compare it against. But I have seen private equity. One of the big institutional investors, private equity players, have been investing heavily in car washes. Okay, so they're going to be building that out as much as possible over the last couple of years. Really, it's been a really interesting look into that type of investment into car washes. And what they're doing is they're buying private equity businesses or private equity firms, right? Are buying older car washes, putting them together into like one large company, and then they can sell services across each one, and they can sell memberships across each one. It's very, very interesting kind of growth in the car wash market, just because it's got that capitalization now. Of course, in the past, car washes have always been single investors. One guy owns maybe 2 or 3 car washes, right? Well, now you've got that huge capital exposure or explosion, investment from private equity that is buying up car washes all over the place. And of course, that's just increasing the number of car washes out there, the amount of capital out there. So it's really interesting how that's really taken up with private equity over the last couple of years. But again, basically, they're buying these older car washes, putting them into a huge company of, 100 car washes. And then they can say, hey, buy a membership where you get 3 car washes a month for a set fee. And you can go to any of these car washes around town that we now own. So it's very much a, operational change to those business types as well. And they're making a lot of money out of it. Okay, currently studying 2 majors and minor, first major finance, risk management, insurance. How do I know what career to get into? Christian wants to know, he's currently studying, he's got a major in finance, major in risk management, insurance, minor in mathematics. How does he know what career to get into? I'm not sure that I could help you there. I got into venture capital, equity analysis. It's always very profitable there. If you're at all interested in the equity markets and that kind of thing, obviously venture capital, lots of money in there. But anything in finance, you're probably going to do well. Risk management, finance, you seem to be kind of towards that. Maybe you could be a compliance officer, things like that. Okay. Julio wants to know about Rumble. Sorry, I love seeing you here, Julio. Thank you for being here, but I really know nothing about Rumble. I haven't looked at it. I'd have to do a little bit more research in it, but let me get back to you, and I'll talk about it in our next live stream here in 2 weeks. Should we consider selling out MPW based on 112 FFO we just saw? Okay, so Andres, looking back on that NAREIT information that showed, I think it actually showed 138% FFO payout ratio. Again, you have to kind of double check those numbers just to make sure, because it is certainly not an FFO ratio of 138% in shares of MPW. It's closer to that. I think it was like 77% FFO that we found. It's actually 73% because, so if you look at the dividend, by a REIT paid out each year, over the whole year, $1.16 paid out by shares of MPW, divided by FFO, so funds from operations, expected of $1.57 this year. I think the company is actually guided a little bit higher, about $1.60 or something. But anyway, $1.57 expected FFO this year. Divide $1.16 divided by $1.57. That's your FFO payout ratio. Okay, that's the funds from operations going to pay that dividend, and that's about 74% for MPW. A little bit on the high side, but definitely not over 100%. Not covered, not something in the danger zone that I would consider selling the stock because of some kind of a dividend cut. Again, we are starting to see a very good rebound in facilities for healthcare services, hospitals, things like that. We're starting to see the fundamentals and the operational cash flows expand or come back up on those. So a lot of those, not the problem they were a year ago when MPW was having all these problems, especially with those two larger tenants. What else? Thoughts on MPW? Just covered that. Good morning. This is my first live meeting. Recently found your YouTube channel. Greatly appreciate. Hey, good to see you here. Seattle, Michelle. Good to see you there. We've got a couple Seattle people here. I know Melanie's there in the chat. Also from Seattle there. Live VNQ, a REIT or EFT. So if Catherine wants to know a VNQ, we looked at that a little bit earlier. Vanguard, the Vanguard Real Estate ETF. That is an ETF, so a fund of REITs. Okay, so you've got some ETFs like the SPY, right? This is the Spider S&P 500 REIT or S&P 500 EFT. Or man, now you got me saying it. Exchange Traded Fund ETF. Okay, sorry. So the fund holds all the companies in the S&P 500 in one stock that you can buy just like a single stock. That Vanguard Real Estate ETF, that does the same thing except with REITs. Okay, so it owns all the real estate investment trusts in its index. It might not own all the real estate investment trusts, but it owns a couple hundred, I think, all in one stock. So it is a great way. As well as the XLRE. The XLRE is the Spider version of that. So it also owns that group of real estate investment trusts. Great way to get overall exposure to the entire real estate investment trust theme, the entire REIT theme, without having to pick individual real estate investment trusts. Now, I still prefer to buy individual trusts a little bit, just because, again, you have to look at these by property type. Okay. You have to understand that there are big differences in demand, supply for each of these property types. So, it helps to kind of fine tune your exposure, with individual ones, like why I own, shares of MPW, why I own shares of DLR, Digital Realty. But then also, you can have that overall exposure as well if you just want that exposure to the entire real estate theme. So a little bit of both, really. Would you kindly increase the size of your mouse cursor? Maybe change the color to yellow. Okay, I'll have to do that. To the next one. So Tyrone wants to know, increase the size of the mouse cursor on that. We'll have to figure out how to do that, Tyrone. But I'll definitely look at that for future live streams. Thoughts on NYMT? NYMT is New York Mortgage Trust. That's another mortgage trust or mortgage REIT. Now this one, it's not so big. I haven't, full disclosure here, I haven't really looked at New York Mortgage Trust much, so I really couldn't tell you the fundamentals. I know it is a little bit smaller than some of the other mortgage REITs, like AG&C, like Two Harbors. So I would tend to prefer the larger mortgage REITs, just because they're going to have, a little bit higher capital base, a little bit higher asset base to have that financial survivability to survive this kind of bad yield curve environment. New York Mortgage Trust, I would wonder if most of their assets, most of their mortgages are there concentrated in New York, which obviously gives you a little bit of geographic risk. Not that it would be bad. I mean, maybe it would work out in their favor if the New York market just rebounded better than elsewhere, or if the yield curve was better there specifically. So it might work out in their favor. But then again, when I'm investing in a REIT, I want a little bit more geographic exposure and geographic diversification, right? To save me from, one particular area anyway. So I would want to look and make sure that, if I did want that geographic exposure, then and their mortgages were more concentrated in New York, as it appears they may be, then I would want to maybe look at some other mortgage REITs. Again, in that mortgage REIT space, you've got a lot of very good names, very high yields, other mortgage REITs that you could look at. You don't have to, only go for this one. So again, mortgage REITs, AG&C, Two Harbors, you got New York Mortgage Trust here, but I would look for a little bit better exposure. What else do we have here? Next sector rotation. So Ambrose wants to know, are we in the next sector rotation? Looks like tech is cooling. The safer sectors are picking up. Great question. I think it's a smart question, because I do think we are seeing some kind of a regime shift, or a shift in sectors. If we do look here at the sector tracker, we can see that year to date, technology stocks, communication services, consumer discretionary have just exploded, really led the market, in the face of, most of these other sectors really not doing that well, really not supporting this 18% run in stocks in the S&P 500 year to date. It's really been just those three sectors. So of course you have to ask yourself, is the change in the economy, is the change in the rate outlook, the interest rate outlook, is some other kind of factors going to change this? When are we going to see some kind of a shift in the in the sector outlook? Because a lot of times, if you follow the business cycle, then you can kind of predict, okay, which stocks or which sectors are going to do well in that stage of the business cycle, especially the interest rate outlook. Okay. If you do look, you look over history, when interest rates change, a lot of times that affects the sectors so much that you'll get some sectors that will always outperform in an interest rate, in a different interest rate environment. So something like real estate, obviously. So as interest rates start coming down, then real estate does really well. Financials, in the early stages of an economic rebound, a lot of times financials, because of that interest rate curve, will start steepening. Financials will do well. You've got utilities utilities and consumer staples that tend to do well when interest rates come down, right? Because they're very high dividend paying stocks. Well, if interest rates start coming down, that means bonds start paying less in interest, or new bonds are lower interest rates, right? So as interest rates rise, a lot of people in those dividend plays, like utilities, like consumer staples, start to say, hey, I can get just as high interest rate or just as high interest yield from bonds or from other fixed income investments. So they start selling their consumer staples. They start selling their utilities and get into those. So as we start seeing interest rates come down, maybe we'll start seeing a little bit better performance in something like utilities that have really been beaten up hard here over the last year. So I do think we are starting to see a shift in the leadership in the market. If you look here in the last 5 days, technology stocks, I believe, if you look out just in the past 5 days, technology stocks have really started to underperform, as well as really all three of those. This is really interesting. You see all three of those sectors that led the market here in the year to date. So over those first 7 months, just in the last week, just in the last month, probably really. They've done a little bit better in the last month, but here in the last week, it really amplifies the idea that these big performing sectors have really turned around. Now, a couple of things here, so obviously we're starting to see some very strong leadership from energy. I've been talking about this in the last week or so, last couple of weeks actually, that oil prices had already come up over the last couple of weeks from $67 a barrel up to $77. I think they're around $78 a barrel now for West Texas Intermediate, or up around $80 or more for Brent crude. But we didn't see that rise in energy stocks. We're just now starting over the last week to see those energy stocks really coming back and really catching up to the price in crude oil. And I think that still has room to grow. We just saw Chevron's earnings yesterday, did very well, started to talk about the cash flows, the improved cash flows from those higher oil prices. And I think if oil can keep that, $75+ per barrel oil, I think you continue to see energy rebound, because, over the year to date, we've seen energy down 2%. So, we're starting to see still seeing some attractive valuation in energy anyway. But you have started to see that some of those communication services stocks, which is of course the internet names, things like that, technology stocks, you start to see the valuations get very high there, and very hard to justify those kinds of valuations. So I do think we are starting to see some sector rotation here. So I would start looking at maybe the losers over the last year, year to date, or over the last year. Start looking at which ones are going to start rebounding. So you can look here in the sector tracker by the spiders. That's sectorspiders.com. The sector tracker here, you can play with the dates here. We can look here, real estate down 7.8% so far this year, one of only 2 sectors in the red. But again, I think, with the stuff we've talked about here in this live stream, I think that starts, rebounding here over the next 6 months. Utilities down 1.6%, the only other sector in the red here. And utilities is the ultimate safety play, right? Utilities, it's a regulated market, monopoly market. To see a 1.6% loss, over the last year, you're starting to see some good valuation in those. Obviously, even a rebound in utility stocks isn't going to make you rich. These things are never going to go up that much as a whole. You might get individual companies within those if you look in here. But you are starting to see some nice valuations, I'm sure, in these. Dominion Energy, one of the largest utilities there, down 30% over the last year. So I would definitely be looking at that. Looking at Duke, some of these that have been hit hard. AEP, American Electric, some of these very large utilities that have suffered 5, 10, 30% down over the last year. Look at the valuations in them, and I think, for the safety in these stocks, I think you're going to do very well, adding them to your portfolio. What else? Novio, MPW, GLPI. Okay, Jose wants to know, are MPW, WPC, GLPI good diversification in REITs? So MPW I like, that's Medical Properties Trust. WPC is WP Carey. GLPI, Gaming and Leisure Properties, Property Investment, Property something, if I remember right. I like all 3 of those. I've invested in all 3 of them. I think I sold 2 of them just recently, not too long ago here. But I do like all 3 of them. I like, obviously we've talked about MPW, talked about that long-term demand in healthcare properties. Very strong dividend yield there. I like that one. WP Carey is a diversified REIT. It's going to give you very strong exposure, and I think I almost like WP Carey better than some of those other big large REIT ETFs like the VNQ, like the XLRE, because it does give you a very broad exposure to different property types. But I think it's managed as a single company, so you don't have quite the smoothness of those larger funds, but you get the one property. So I do like WPC, WP Carey. GLPI, another very good one, a favorite of mine. Gaming and Leisure Properties, obviously, the REIT, or the gambling, the gambling market, growing in most states, and so they've done very well also. Matthew wants to know about apes. We talked about that earlier. I do like the apes still. I wish they had come down more. I wish they had come back down to $1.50, and I could buy more of those. I still think they could easily come back up to $2 once they get the terms of that settlement that the company re-proposed on Friday. I think that's why you only saw it down maybe 3%, over the last couple of days, is because it is obvious that is going to convert. They are eventually going to convert. Maybe it won't be 1-for-1. Maybe there'll be a payout to AMC investors a little bit, but they will convert, and it'll be worth, at least $2 a share or more. Are you familiar with STWD? Haven't really looked at Starwood a whole lot. That's a Starwood Trust, or the Starwood REIT there that the Quags is asking about. STWD, the Starwood Property Trust. Haven't looked at it in quite a while. Obviously it's one of the larger REITs, $6.6 billion in assets. It is I want to say REIT, a mortgage REIT. Oh, mortgage REIT. Okay. See, I didn't even know. I was thinking it was something else, but it is a mortgage REIT. Okay. So again, within those mortgage REITs we talked about, 6.6 billion is probably the largest mortgage REIT, if not one of the largest. 9.3% dividend yield, strong dividend yield, not too high. I'm kind of skeptical of a lot of mortgage REITs that offer, like we looked at that New York mortgage, I think it was, that had the 18% yield, and the some of the higher ones with Two Harbors. I'm a little skeptical of that high of a dividend yield. 9.3% dividend yield. I can accept that as something that you're probably not going to see a dividend cut nearly as frequently or as soon as you see it in some of these other ones. So I think that's probably quite a bit more stable or safe play compared to some of the other mortgage REITs. So Starwood Property Trust here, ticker STWD, obviously much larger and probably a little bit safer bet if you're looking at these mortgage REIT types of properties. What else? Lifters Gym. Hey, Chad, they're in Albemarle. If you're in North Carolina, stop by the Lifters Gym. Got back into Duke a few weeks ago via executed put. Okay, so yeah, he's in Duke Energy there. Again, those utilities, they're not going to make you rich, but it's probably going to be hard to beat over the next couple of years as far as safety and return. Just the kind of drop that they've seen over the last year. How do you feel about companies like Berkshire and MKL? Okay, don't know MKL, but Snowfire wants to know about Berkshire and MKL. Now we'll have to see here. What is MKL? Markle Group. Haven't seen that, which is weird. I've never heard of that, which is pretty rare that I haven't even heard of a stock. Insurance, property, casualty. So I don't really cover a whole lot of the insurance, property, casualty market. Obviously, I know what Berkshire is. Berkshire, it's hard to beat as far as a one stock kind of portfolio, right? Because within Berkshire, obviously Warren Buffett's company there. Within Berkshire, you're getting property casualty, you're getting a lot of insurance companies, you're getting rail, you're getting retail, you're getting a lot of companies that they own outright. But then you've also got that massive investment portfolio in Apple, in some of their other big exposures. Some of their other big investments are American Express. A lot of those Occidental Petroleum, they own, upwards of 30% of that company now. So Berkshire Hathaway, here's the A shares. You can also buy the B shares, which are quite a bit less expensive, but you still need to buy these on a fractional share website, a website where you don't need $348 isn't too bad per share. But, if you're on a fractional share website, like maybe M1 Finance or something like that, you can invest however much you want, get a fraction of the share, not have to put up $350 per share. So obviously much more easy to buy into those. But, this is something that it's going to give you broad market exposure. And to tell you the truth, I don't know, other than, I guess, about 40% of Warren Buffett's portfolio now here on Berkshire is now Apple. So, they've got a little bit more upside to that. But what I'm thinking here is this is such a diversified portfolio of companies, of companies and that kind of thing, that it's kind of the entire market, right? This is the economy. Okay. Berkshire Hathaway is now mimicking economic growth in the overall stock market so much that it's more of like an index fund. Okay. It's not necessarily something that you're going to buy and you're going to get rich on because, it's going to go up like Tesla or anything like that. It is just going to provide you market returns. And if we look here against the red, so we got the Berkshire shares in the green here, the S&P 500 in red. And you can see, even though the S&P 500 has outperformed here year to date, S&P 500 up 19%, Berkshire shares up 12.6%. Even though there is that gap there, they've followed each other pretty closely. You had a pretty kind of something happening here in the early part of the year where the S&P outperformed quite a bit. But then it's, you've seen them pretty well track each other. If we go here, let's go here to the 5 years. And you can see it's almost, almost very close correlation. Okay, so what I'm talking about in correlation there is when one rises, the other one tends to rise. When one falls, the other one tends to fall, and by pretty close to the same amounts. So again, investing in Berkshire, I'm not so sure that there is a lot of economic additional economic return anymore other than just the stock market. Okay. Again, it's going to do very well if, maybe Apple does very well, or some of those larger bets, some of the owned companies. But I think it's basically an index fund at this point. And you see that here really in the returns over the last 5 years. You do see some outperformance, 75% up for the Berkshire portfolio, 62% for shares of the S&P 500 stock market index. But it's hard to go wrong with basically a market portfolio, because it is going to go up long term. Okay, what is Vonovio? Pat wants to know about Vonovia. Vonovia again. Sorry on this one. I have never heard of that. Vonovia. Looks like it is a DE, maybe a German company. .de. So and then on the U.S. markets, it would be here VONOY in the pink sheets. So this is a fairly large company. I got to say German probably with that .de. So this is Germany, or it's out of Germany. Real estate services. Okay, so it's a real estate stock. They're in Germany. Operates integrated residential real estate company in Europe. Okay, so again, can't give you an estimate or an opinion on something I really haven't seen much of. It looks like 19.4 billion, so it is a large real estate investment trust or large real estate company. They're in Europe, 4% dividend yield. Again, I think just like what we've been looking at here with these other real estate stocks. I would look for some kind of source material or data on expected FFO growth. Your FFO per share for this year, maybe analyst estimates for next year, give you some kind of idea of growth in that FFO, price to FFO compared to other companies in that same property type or across all of real estate investment trusts if it's a diversified REIT, and then the payout ratio. Make sure it's not too high, that dividend might be in danger of being cut because they're paying out all their FFO, but it doesn't have to be extremely low either. So I would just be kind of looking at those kinds of ideas to see if you really like it, as well as what's the general trend in those property types in Europe over the next year, do you believe? Okay. Hey, got a shout out from Seattle Michelle for Albemarle, North Carolina. There you go, Chad. It's pretty. Albemarle, and I always mispronounce that wrong. I don't know if it's Albemarle or Albemarle or whatever, but well, you'll have to correct me sometime when we meet up there. Which are the ones you're interested in investing in for 2024, 2025 yourself? So it's Merlin wants to know. Okay, cut the bullshit. Which of these REITs are the ones that you like the most right now? Okay, and so okay, so let's think back to the ones we were looking at. Obviously, I like MPW. I like that healthcare idea or the healthcare property type. So I like MPW. You could look at some of those other healthcare REITs, figure out which one you like best. I like. There's really a limited choice in data center ones, but I think those are good long-term stories. So maybe Digital Realty, ticker DLR, Equinix is there as well. So you look at those. In the office space, again, I think there's more pain in the office market to come. Going to have to see some massive write-downs in that. Eventually, it's going to be a very strong property sector to look at. So you look at some of those. Look at maybe we talked about Boston properties. You might be one to look at. You want to look at the larger ones that give you very good diversification across the entire country, not necessarily just one segment. So look at those. Frankly, I don't know if I'd be looking at office properties just yet. Maybe give it a little bit more time because I think there's still obviously more pain to come on those. You look at what are some of the other stocks. I do like gaming and leisure properties, GLPI, just because of the growth perspective in that. Again, I do like WPC, WP Carry as a diversified, all-encompassing diversified REIT. You can look at that one. We can look at some of the. I guess we skipped industrials there. Industrials I'd have to look at again because again, I've always liked Stag Industrial, but I think right now the dividend yield is a little bit lower. The payout ratio is a little bit higher. The growth isn't there quite as much as some of these others. So I'd want to look at East Group to see what that's looking like lately. Prologis, I know the dividend was pretty low there, so I would maybe give that one a pass. Retail, I'm not looking at really, just because of that long-term headwinds to e-commerce. Apartments and the single-family homes, I would be looking at that. Maybe American Homes for Rent, AMH, you might look at that one, as well as some of the residential ones that we talked about. I know Equity Residential is always a big name that comes out. I really haven't looked specifically at the apartment rent ones yet now. I think I'm a little bit more bullish on the home builders themselves than the apartment real estate investment trust, just because I think there is going to be so much demand to build ourselves out of this housing shortage that we're in. We can't do it just by sales alone, because people are locked into those mortgages. So I would be looking at I would be looking at the home builders instead. Here we are on the diversified ones. And again, look at this. You've got the WP Carry, which is the diversified REIT that I like. You've got 4% FFO growth, much higher than the overall FFO growth or FFO decline that we see in across the sector. Here, okay, so I'm looking at a negative 26% expected decline in FFO for the diversified real estate investment trust. So that's real estate investment trusts that own more than one property type, that own really exposure to a lot of property types. WP Carry, though, expected to post positive growth, so that's good. FFO payout ratio much lower than the property type average, than the diversified REITs average, just 62% versus 80%. So with WP Carry, yes, you do have not huge FFO growth, but it is positive. You have probably a sustainable dividend there with that stock. So that's one that I would look at. Healthcare, we've got the MPW that I was looking at, a Global Medical REIT, GMRE, probably another one to look at there. Again, with healthcare REITs, you want to be in the ones that own facilities, that own hospitals, not necessarily the ones that own the office space, or maybe even the long-term care properties, the senior living. Those have been pretty much a dog for quite a while there. So I would want to check the supply demand for those rather than just jumping into those. Lodging and resorts. Lots of good possibilities here in lodging and resorts, just because they have been hit so hard over the last couple of years. I do believe this is going to be one of the ones to benefit most from that drop in interest rates next year. So this is one you want to be looking at. You want to look at maybe Host Hotels right there, HST, Ashford Hospitality Trust, AHT, having a lot of pain, a lot of problems lately, but obviously could be one to watch and one to rebound, later on. What else? Still like Stag. So just talked about Stag. Hello from Kim Jong-un. Kim Jong-un on the chat, folks, from North Korea. So that is pretty crazy. What else? First one was right. Hey, Doge for a long time. What do you think about Frel? So Rambo. We got Kim Jong-un and we got Rambo here on the chat. That is pretty freaking awesome. I like that. Hello. Hey, Rambo, good to see you, though. But he wants to know about Frel, Fidelity Real Estate Index. Okay, so another one here that is really your broad diversified real estate trusts here. Okay, so Fidelity MSCI Real Estate Index ETF, ticker FREL. Super low expense ratio, 0.08% that you get from all those Vanguard and Fidelity ETFs. So that's always a good place to start. This again is going to be your broad exposure into real estate. So when you look at these, you always want to start with looking at their holdings. It might not show much here on Yahoo Finance. You might have to go to the actual ETF's website to see what property holdings they have. But you can see here top 10 holdings: Prologis, American Tower, Equinix. So you've got office here, you've got cell tower, you've got digital, data centers, with Equinix. Crown Castle is another cell tower. Public storage, self-storage. Welltower is hospital. Realty Income is REIT, retail. Simon Property is malls, Digital Realty, another data center. So it's pretty well diversified across those. You kind of want to. You're saying that all these are good property types. You like property types across the spectrum. It looks like maybe it's a little overweight in cell towers. Obviously, it's got American Tower here 7%, Crown Castle 3.9%. So it's pretty heavily exposed to cell towers there. It's got just the one public storage. It's got just the one healthcare here. It's got it looked like Equinix and Digital Realty Trust. So it's got pretty good large exposure to data centers, 5.7% plus 2.5%, data center exposure, retail with realty income. So it's, some property types, a little bit higher exposure, office space here with Prologis, right? Wasn't that office? I get Prologis confused with some of the other ones quite a bit, but 8.8% exposure there to Prologis. So you really want to check out your property exposure in those. So make sure that it is in fact diversified, not really targeting one or two or three specific property types. But again, getting that one fund, that one ETF that gives you broad-based exposure, it's hard to go wrong with that because you do have that diversification. You're just going to get the market return on real estate investment trust, which we've seen is really good. Over the last 50 years, 12.7% annualized returns on REITs. So very good return on that, the entire market. So if you can buy the entire market and you want to do that, then that's it's hard to go wrong with that. Snowfire. Us old folks are staying in our homes now. Hey, you got that right, buddy. We're buying our home and we're moving over the next month here, and I hope it's the last time. I hope we can stay in that home, even if I'd like to refinance here in the next couple of years. But all you guys that have mortgages that are over a couple of years old, you're locked into those rates, and those supply of homes is going to be a tough one. So that's why I say home builders are going to do really well building us out of that supply deficit for homes. GMRE, we talked about global medical REITs, global medical real estate, ticker GMRE. That's a good real estate or healthcare real estate one that I've watched in the past. American Tower, also another one, American Tower, as well as some of the other cell tower REITs have fallen lately. I think those have some good upside potential. What else do we have here? Selling puts for positions. Teddy, the stock picking poodle, wants to know, do you like selling OTM out of the money puts for positions you would like to own, like MPW or SoFi? Okay, so that's out of the money puts. That would be basically selling puts on something, collecting that premium, kind of a cash secured put. So I have the money that I would want to invest in that stock. Instead of just buying the stock outright, I sell puts on it. I collect a premium from someone, and if that stock goes lower, then they sell those shares back to me because of those puts. I keep the premium. I get the shares for that amount. Minus the premium is my new cost basis. So it's a way of getting into a company for maybe a little bit less than what it is trading at, or just collecting the premium if the stock price goes up. I've done it in the past, and it's kind of a case-by-case basis a lot of times, especially for something like SoFi, which is a growth stock, which is something that, just as we've seen just over the last few months on SoFi, that thing's gone up like 80%. It's really dangerous for something like that because, if you sell out of the money puts in that, you collect the premium and you don't get the stock because, if it goes up so much, you miss out on that massive upside that it's had. So for a lot of growth stocks, I probably wouldn't do it just because, you want that eventual big bounce in the stock when it does come by, and you never know when that's going to come by. It would have been very hard to predict precisely when that 80% run was going to come. So you miss out on a lot of that with those growth stocks. With the maybe the dividend stocks or the slower growth stuff, like maybe the utilities, things that aren't going to run 20 or 10 or 20% in the next in a month or two, then it's a good strategy that you can use. But again, you just got to be worried about, missing out on a lot of the upside return for just kind of the limited premium that you collect. And it's something that you just got to manage. It's also a little bit more tax intensive, right? So, you're going to pay higher taxes on those premiums that you collect. You're going to pay those as income tax rather than capital gains. So that's something else to consider when you're doing that. A lot of times, the simplest way to invest, just buying the stocks outright is going to be the best, just because of the other things. A lot of times you don't consider. Excuse me. Okay, so Pan wants to know, can you say some home builders you are watching? Well, no shit. If I love the home builders, why don't I give examples of the home builders? Thank you. That's a great question, actually. So home builders, Pulte is one. So Pulte is PHM. Yeah, PHM. So with the home builders, there aren't a lot of them, and they're really pretty closely correlated with each other, I think. None of them, I don't know that any of them have a real competitive advantage against each other. So here I would be betting on, the entire home builder index probably, which I think there's actually an ETF that covers that. So maybe you just buy the index, the ETF. Actually, let's look for that, because I want to, if I'm saying there probably is one, then let's home builder ETF. Okay, so the XHB. So you could buy these individual ones. We've got Pulte Group, PHM. We've got Lennar, DH Horton, ticker DHI, KB Home, ticker KBH, Toll Brothers, ticker TOL, Beazer Homes, BZH. Now, again, I haven't spent a lot of time researching home builders. I've never really seen much of a competitive advantage in any of these. Maybe you look at the performance of these in a chart over the last year, 2 years, 5 years, see if any of them really look like it's really outperformed, and why it might have outperformed. Maybe if one does have a competitive advantage, but I've never really seen it in a home builder specifically. So really you're betting on just the kind of the market, the overall market for home builders right now. So in that case, you just go to that XBH, KBH, right? KBH. No, what was that? XHB. My mind is slipping. XHB. This is the Spiders S&P Home Builders ETF. Okay, and again, you look in holdings, and it's going to show all those big home builder stocks. It's going to show Builders First Source, Owens Corning. So, that kind of scares me. This. So basically, it's got Lennar, it's got Pulte. It's going to have those home builders, but it's also going to have a lot of the other stocks, companies that go into building a home. So Owens Corning for the fiberglass insulation, Builders First Source, probably a home improvement or Builders Resources, right? It's going to have Lowe's companies. It's going to have Home Depot in there. So you're probably, if home builders do really well, they're going to be using all these supplies, all these other companies. But if you want exposure specifically just to the home builder, I think I'd probably rather have that than you want the individual companies. So Lennar, Pulte, DR Horton, DHI, things like that, rather than the entire home building universe here in this XHB. So it's your call. Again, as home building really builds us out of this supply deficit in homes, you're probably going to see this fund do very well. It's going to be a very easy one-stop shop for your home building stocks. But it is kind of over diversified, I think, into some of these, into all of these ancillary, companies that go into building a home. So I would compare that against some of the individual home builders like DR Horton, like Pulte, like Toll Brothers, and things like that. But good question. Okay, Jorge wants to know about IIPR and cannabis business. So, IIPR is a real estate that owns like cannabis shops and cannabis related properties. So obviously that is going to be very closely connected to the cannabis industry, to the cannabis business. And I got to tell you, this is my fault partly on this. I've talked about cannabis companies in the past. It looked like it was going to be a viable business. But it just, over this past year, cannabis and the whole industry has seemed just like a money losing proposition. Okay. I know, I don't have any direct connections into the underground market for it, but I'm told, and all the research I've seen is that the legitimate cannabis market just can't compete. They just cannot compete with the prices and the prices you get in the illegal market. And now, since most states are decriminalizing cannabis and all that, then there's really less and less of a incentive to go the legitimate route, right? To go to your local dispensary or whatever, or go to a doctor and get a prescription for cannabis, than just to get the hookup from somebody down the pool hall or wherever, right? So just because the insane taxes levied on those cannabis companies, it makes it very hard for them to compete against the guy down the street that doesn't have to pay the taxes. Okay, so. It's a tough market. I'm not saying that there can't be good returns in it, and you need to research that and figure out if it can turn around. But just from that big top level picture, it just appears that cannabis companies and the cannabis industry just cannot compete, especially, as I said, as states decriminalize possession and usage. Then why would you even go the legit route if you can pay much lower prices, to your local guy? Why pay the higher prices at the dispensary? So that's just something that I kind of came to the realization of over the last year after looking at the cannabis industry a little bit closer and that kind of thing. Yeah, who said deer space? There we go. So Bray Ness obviously watched the video yesterday talking about deer space exploration ETF. It's crazy. That's something you always have to look at in ETFs, folks. I mean, I love ETF investing. All you out there in the Bowtie Nation know I talk about the core satellite strategy, where you invest most of your money in ETFs to give you that broad exposure, stress-free investing. But you cannot just buy an ETF just based on the name and think that's exactly what you're getting. Okay. This Homebuilders ETF, a little bit on point with stocks that go into home building. I mean, I was confused. I thought maybe it was just the home builders themselves, but no, it's, the home building, the whole construction market. But you got some other stocks like we talked about yesterday in the market update yesterday, that value stock ETF that's got anything but value stocks in it. The space exploration, the ARC space exploration ETF that Bray's talking about here, it's got deer in it. What the hell? I mean, we need combines on the moon already, or what? I guess I missed that. Big Futurama fan, but as far as I know, we don't have deer needed on the moon just yet. So yeah, you got to look into the holdings for these ETFs to make sure that's the exposure that you're looking for and what you really want in those before you buy those ETFs. And again, like we talked about in that market update yesterday, you can always, any ETF, you can go to Yahoo Finance, go to holdings. It's going to show you the top 10 stocks, or if you just type in Google, look for the ETF webpage itself, it's going to give you a downloadable link to the entire holdings for that ETF. Let's just see exactly what is in there. Okay, let me try. Rose Bucket wants to know about OHI. That's Omega Health, I believe. If memory serves me, that is another, obviously, real estate or healthcare real estate. I think it's facilities. Last I checked, OHI, Omega Healthcare Investors. I think it's very similar to MPW, right? 8.2% dividend yield. I think it's mostly facilities there. So that would be another good one to look at, healthcare facilities. Long-term healthcare industry this one's skilled nursing and assisted living. So this is a little bit different from what you get with something like MPW, like I think global medical real estate, GMRE, going to be a little bit more office and facilities. So this one with the Omega Healthcare, this is more assisted living, senior healthcare. This is really very much the supply of senior living facilities. You really have to be on top of that. I know on the face of it, it would seem, hell, we're all getting older. We're all needing, senior living facilities eventually. I'm hoping sooner than later because some of them look damn nice, do everything for me kind of thing. But just the overbuilding over the last decade or so ago of these has really held down stocks in the industry, in the space, has really held down rents, things like that. So you can't just look at the top level demand or the expected demand for these kinds of facilities. Obviously, most people, not me, want to grow old in their own homes. Don't want everything done for them in a facility, which sounds kind of nice actually. So people are living older, living in their own homes and not going to these living facilities like we thought they might. So it's something you got to consider about these. Maybe someday they'll rebound, but Omega and a lot of the other LTC properties, ticker LTC, a lot of the healthcare senior living facilities related REIT stocks haven't really done very well over the past quite a few years. What else? For cheap, sign it on the street. Okay. They need a tractor up. ARK has high fees. Yeah, it does. Pan says ARK has high fees. Yeah, you look at one of the other things you look at these ETFs is if you're paying fees of 0.75% expense ratio or higher, then hell, why not just buy some of the individual stocks that they own, which you can see in their holdings, and not pay any fees at all? So it's something else you got to consider for some of those higher fee ETFs. Okay, C40 Blaze, 40 Blaze, nice. Bit off topic, REITs, but do you believe TDOC will bounce back? Earnings today will show us more. So Teledoc Health, it was in our newsletter this last Sunday that we sent out. Actually talked about it yesterday in the market update as well. Going to be reporting earnings maybe tonight, maybe tomorrow. I got to check exact date on that. But, I like Teledoc. I like One is just the long-term demand for virtual healthcare. Okay, no, we're not going virtual healthcare like we did in the pandemic, and it's going to take a long time to get back to that point, if ever. But the trend is towards virtual healthcare. It's much cheaper. It's much more accessible. That's just the way we're going. Teledoc dominates that field. Okay, there is no other company. Even Amazon bought a virtual healthcare company not too long ago, or agreed to buy one, and it is a fraction of the market. Okay, and so Teledoc dominates a growing industry. That's 2 points that I look for in growth stocks, in long-term forever stocks. Okay. Two, the comparables are going to be very easy. Over the last year, it's taken tremendous write-downs on its goodwill, on its balance sheet. That's what caused the earnings per share to be like negative $84 or something. So it's taken all those write-downs. It basically threw everything in the kitchen sink out the window. So the comparables, comparing this quarter's earnings, next quarter earnings against last year, going to be very easy. Going to be very easy to beat those earnings. And it's still 9% sales growth. Okay, so even though sales growth has come down, the growth in that virtual healthcare market has come down. It's still a solid growth rate, 8% on sales. And it's trading for like 1.62 times price to sales basis. So this is a growth stock, or a stock in a growth industry, which I believe will see that growth again, double-digit growth in sales, trading for like normal stock price to sales basis. Okay, 1.6 times price to sales is very cheap, especially for anything with the potential for growth. So I like Teledoc. I own Teledoc. I own a big portion of the shares in my portfolio. So yeah, I do like Teledoc. So stay at home, best bet. Some are cruel to older folks. Sabra. So Jeff says Sabra is good. SBRA is a good healthcare stock. Yannick wants to know about infrastructure REITs like American Tower. Again, I think REITs like American Tower, the infrastructure, the cell tower ones, American Tower, Crown Castle, CCI, have been beat up a little bit, with the news around AT&T and Verizon. I don't think it affects them. So I think the dividends are pretty good. We're going to need those cell towers. We're going to need that to continue. So I think, you can look at American Castle, definitely. So we're in 2.5 hours. I think this is the longest live stream I've ever done. I appreciate it, everybody, for coming. Don't forget Tesla video tomorrow. Going to be a really cool look into how much you'd have investing $100 a month in Tesla, as well as some of the other growth stocks that really work for that kind of strategy of investing. Check that out. It's tomorrow, 11:45 a.m. Eastern time, when the videos come out. Until then, check out last week's video, fastest ways to live off dividends. I'll link that up here in the card. Check that out. Appreciate it, everybody joining us here. Love these kind of connections and question and answer we get here, and I will see you in the next video.